to 20% across the board, and 60% on China, and those are big numbers. So other countries are preparing to retaliate, and that will hit our exports. You will have supply chain disruptions, and so I think one of the debates right now is just how much of a shock we're looking at. Is it a one-time shock on the $3+ trillion that we import? And how do we calculate and factor in retaliation right now? Trump is actually not going to have his agencies staffed to actually look at how you remedy or negotiate out of these the unilateral across the board. We trade with about 200 countries and territories. So this is going to be long, and it's going to be messy, and it's going to be inflationary. It's going to be targeted at China, but Mexico is going to take the brunt of it. EU, big trading partners. It's where you saw a lot of the FX movement in Japan yesterday, and in the yuan, and the peso. So I think you're going to have a lot that's going to come and hit that first week that he's in office, because he knows what he wants to do.
Heidi, do you already think we're seeing the fallout of Trump's promises, in the sense that basically we'll have the collapse of the German government?
So I think that Germany has its own dynamics. So it's a very good question, but I think what I would focus on more is what the direct impact will be on the U.S. economy. You have a lot of reshuffling in various countries trying to figure out how they're going to manage this transition to a Trump presidency. In terms of I think you talk about the changes happening in Germany. Well, the whole dynamic with Europe is about to change in a very big way. You are going to have, on the back of a very different policy towards Russia and Ukraine, and dealing with NATO, you're going to have a lot of deep conversations about what European security is going to look like moving forward.
Heidi, you think that Trump's going to come in and put his promises directly in focus. You have some individuals that are close to former presidents that say this is a negotiating tool. If he was to put 60% tariffs on Chinese imports, we could see a meltdown in financial markets. And what we learned from Trump 1.0 is that keeps an eye on what stocks are doing. Is that going to be basically a regulating force on Trump and his administration?
So he does focus very much on the stock market. I think at some point he will have to focus on what's happening in rates as well, because this is going to significantly complicate. We have FOMC later today, and it complicates the Fed's job next year, because you will have this combination of inflation, growth, and tax cuts on the table. So you're going to have a slower pace of easing. I can see some very difficult public conversations between Jay Powell and Trump that there's a lack of them last time, but I think Trump has also made it clear he wants a lot more influence on the Fed. But there are a lot of spillovers. So if you're talking about fewer, lesser easing, or a real potential of rate hikes, which I think is, plausible, the spillovers are to higher mortgage costs and corporate borrowing, and huge spillovers. I'm not sure Trump would care about emerging markets, but from market perspective, emerging markets will take the hit as well. So you have a whole new set of risks on the table for next year.
Heidi, you went through a lot there, and I want to pick out one aspect of it, the stock market performance, particularly of financials. There is this expectation that there'll be a mass wave of deregulation that will really help the banking stocks. You actually orchestrated bank regulation, bank legislation heading into 2011, and I'm just wondering, how difficult will it be for Donald Trump to unilaterally deregulate the banking sector?
So I think anything that involves, any other parties and negotiating with any other parties is challenging. So deregulation on a whole host of issues, banking, or anything having to do with wanting to cut red tape in all of the permitting that he's looking to do. it's more complicated than I think anybody knows when they're going into government. So I do think that it is going to continue to be. I mean, deregulation is going to be positive for certain industries, and that is I think that is going to continue to be a longer term play in terms of what to watch for. Again, I'm going to go back to where I started. The real risk that I see near term is the impact on that is tariff policy will have.
So it seems like just in terms of sequencing, tariffs first, and the deregulation will take a lot longer, and that'll be a more protracted type of implementation. You said something else that I thought was really interesting, that you don't see some of these offices that are going to be negotiating with different countries and different agencies fully staffed. Why do you think so?
So, I mean, it takes a lot of time to get the right people in place and up to speed on the agenda, whether you have, no matter how talented your people are or how prepared your transition is, it still takes a long time to get up to speed and actually meet your counterparts. So we do have, and I think that, there are certain countries where I think Trump himself will want to have the direct bilateral negotiation, but there are only so many countries that he can do that with, and they're going to that is going to be, as we've seen in the past, personality driven with the leaders of those countries. It's also it's going to mean that you have any decision making on tariff relief probably more on a case by case, even company by company basis. So friends of Trump are probably going to benefit from anything that would be relief on any tariffs.
Heidi, it was great to get your perspective on things, on tariffs and what it could mean for the global economy. Heidi Kribo-Reneke there at the Council on Foreign Relations, and also what it could mean stateside. I think we have to emphasize, not my opinion, the market's view, that the market was pricing in yesterday a positive growth shock. You could see that in equities, and you could certainly see it in bonds as well. But there was a very interesting divergence taking place between the United States and the European bond market. And we talked about it on the program yesterday. At the same time that bond yields in America at the front end of the curve were rising by double digits, German two-year yields were dropping by more than 12. Why? Well, the wires in some of the strategist notes of the last 24 hours, downgrades to the outlook for the European economy. Goldman, as Lisa suggested about 20 minutes ago, upgrades to the outlook for the US economy. That speaks to the divergence. Then Germany happened, and German politics specifically started to happen. Scholz dismissed his finance minister with some pretty scathing language. And what does Scholz want over in Germany? He wants some wiggle room financially. So all of a sudden on the ballot in Germany is higher spending. Why do they need higher spending? Because they are not in a position to lead Europe at a time when the United States is not on the same side as them on several key issues.
Yeah, they want higher spending because their economy is flat on its back, and everybody's been wondering when Germany would finally expand its budget. Another issue, though, of course, for Olaf Scholz is that he is losing popularity. And so some people are wondering whether he's firing Lindner, his chief finance minister, as a scapegoat to then prepare for something else. Nonetheless, on a bigger picture level, it just highlights the ripple effects of the U.S. presidential decision on the rest of the world and how that divergence can widen as some people expect it to, both in the currency markets as well as in the rates market.
It feels like Trump was the final catalyst to break up this coalition. This coalition only existed because Russia's invasion of Ukraine, they were able to coalesce and come together how to fend off the fact that they're no longer going to have cheap Russian energy to fuel their manufacturing base. Christian Lindner, he's the one that actually cared about the debt and sustainability. And Scholz is looking at what they're dealing with in Germany. He's like, we're going to have to spend more.
And that's why German bond yields today are moving in the other direction. This language from Scholz, too often the necessary compromises were drowned out by publicly staged disputes and loud ideological demands. Such egotism is completely incomprehensible. Look who's playing publicly now. That is some brutal language from the German Chancellor. Up next on this program, Erica Najarian of UBS as US banks rally big time following Trump's big victory. That conversation up next from New York. This is Bloomberg.
think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Record highs on the S&P 500, on the NASDAQ 100 coming into Thursday. Equity futures adding some weight to the rally, up by 1/10%. What a move in small caps yesterday. The best day for small caps in 2 years. On a Russell, we're up by 0.5%. In the bond market, huge moves, 2 years. Out to 30-year bonds. The 2-year this morning, yield was just a little bit low. We take a pause. 425 on 2s, on 10s, 444. The Federal Reserve hardly mentioned the thing. They've got a decision a little bit later.
And basically, this is going to be a boring one. That's what everyone says, except this is the reason why everyone is going to be glued in when Jay Powell takes the stage at 2:30 p.m. and we'll be airing our special on Bloomberg Television later today. So we will be here. But there is this real question. How will he talk about the outlook and how much they are watching the potential for what the markets are sniffing out to be reality, which is accelerated growth, inflation ticking up, and bond yields on the long end that they don't control as being significantly higher.
Their commentary until we see the actual policy from a Trump presidency is going to look so stale, so redundant for the next several months. And they've got to put together forecasts in December. And I'm not sure how redundant those forecasts will be. I think they will be very redundant based on what we can already see taking place in 2025.
They will try to be boring. They will try to say nothing. They will try to say we're just going to look at the data. However, and this is, I think, the big rub, right now, the fact that yields are climbing on the long end to such a degree that we've seen almost 100 basis points of an increase in about a month or two raises this question. First of all, was it a mistake for them to cut by 50 basis points? And second of all, does that tighten financial conditions in a way that seriously weakens the economy? And if it doesn't, what does that say about the neutral rate?
The 10-year, the morning that they cut interest rates by 50 basis points, in the 360s. This morning, one meeting later, 440. Huge change. In the FX market, big change yesterday as well. The worst day for the euro going back to 2020. And I really do want to sort of re-emphasize what we were talking about yesterday, that moves yesterday cross-asset happen a couple of times every decade. So the kind of moves we hadn't seen since 2016, 2020. So that's Brexit, the Trump presidency, plus a pandemic. Those kind of moves were taking place yesterday.
It was a game changer. And that's what the market was saying, and that's what people were saying, because essentially, as we just heard about from a host of different analysts downgrading the outlook for Europe, expecting the ECB to cut rates more significantly, and possibly hampering the Fed's ability to cut rates next year. That differential expressed in a sudden seismic move in the euro. And honestly, it doesn't seem like people are moving away from this. It doesn't seem like people are so ready to say, ooh, it's a dislocation, I'm going to get in on the other side.
Small bounce on the euro, 107.61, positive by a third of 1%. A small bounce, just a tiny bounce in the grand scheme of things. Under surveillance this morning, the GOP taking control of the White House and Senate. The House still hanging in the balance. Democrats need a net gain of 4 seats to take the majority. How close are we?
We're very close for the Republicans to have this trifecta sweep, but we are still waiting on a little bit more than a dozen key races that we need to know whether or not they put over the finish line. But I spoke to former Speaker of the House, Kevin McCarthy, yesterday. He was like, look, especially waiting on in California. He knows these California districts really well. He's like, it looks like it's going to be a red hold on this. Speaker Johnson already putting out a letter saying that he wants to run for Speaker again. He's been joined at the hip the past few months with the former president, who's now going to be the future president. So it looks like he'll probably be able to maintain his gavel if they hold their majority, as well as Steve Scalise putting out a letter. He wants to have his number 2.
French Hill, the Republican from Arkansas, joining us in about an hour's time, so look out for that conversation. The latest out of Europe, German Chancellor Olaf Scholz calling for a snap election. Divisions over how to revive the country's economy, triggering the breakup of his three-party coalition. The crisis coming to a head after Scholz dismissed the finance minister, Christian Lindner.
And called for a snap election, basically this idea that he's going to have a confidence vote potentially as soon as the next few months, and then after that, an early election. Here's the question. How much, A, was this really catalyzed by President Trump getting elected and reelected? And second of all, how much is there more to come? And that's, I think, something that a lot of people are talking about at a time, especially Germany, the poster child of not spending when rates were at negative levels, now suddenly rethinking that as they're facing off against a new wave in the United States.
This has been brewing for a long time within this coalition, because this coalition did not make sense in terms of how they felt about finances of Germany. It only made sense when they were dealing with a crisis, and that crisis was Russia's invasion of Ukraine. Now, they basically are recalibrating for the fact that they have a very slow manufacturing sector. The auto industry is on its back, and they're going to be dealing with the Trump administration that is what they would probably call hostile to them. You brought up a great quote, though. Olaf Scholz
Brutal.
basically saying that Christian Lindner is an egomaniac as he dismissed him. Incredibly embarrassing.
Based on that language, I think there's a strong suggestion. I think this answers your question. It's been brewing for a while. I will say that the election, though, here in the United States, I think justified the urgency, that they've got to get something done and get it done quickly.
It also feels like this is a seismic shift globally, and we've seen a lot of upheaval internationally as to leadership. And I wonder if that's because of the populist wave. I wonder if it's because of the economic situation and what happened with the pandemic and the inflationary shock. And I wonder if it's because, frankly, the trade structures are breaking down from the traditional way. And you put this all together, and it's the reason you're seeing such big moves in markets, because people in the market are trying to understand what this new regime looks like at a time of a great degree of uncertainty.
Big shifts in trade as well. China's about to get a little stimulus boost for maybe 2 months. China's export growth surging to a 2-year high in October. Factories ramping up shipments ahead of the holiday season, and anticipation of worsening trade tensions. What do you think is going to happen over the next 2 months? If I need something from China, I want it yesterday. I want it right now.
Which is basically what you're seeing, right? Some people speculating that maybe this has a bit of some sort of rebound effect from the typhoon last month, but nonetheless, that is the main point. It's basically front-loading all of those orders as companies try to get ahead of this, which raises the question, how companies are going to try to get around this. And that's the reason why the focus is on Mexico, on Vietnam, on some of these connector countries that really are sort of the intermediaries to make things look like they're not coming from China or the United States.
That's the latest on China. Let's get to the latest on the financials. Banks seeing their biggest one-day gain since 2020 on the S&P 500, ahead of Trump's second term. Erica Najarian of UBS writing, we think banks will have more excess capital under this administration, especially as the president-elect reshuffles the decks on agency leadership. Erica joins us now for more. Erica, good morning.
Good morning.
I'm going to start with a note from one of your peers, because it's very rare to see a sell on JP Morgan. David George of Baird downgrading the stock to underperform, saying it's time to take profits. We're more than fully priced here. We know and we agree that JP Morgan is best in class, but investors are paying peak multiples on peak earnings, in our opinion. What would you say back to calls to say that we've just had a year's worth of moves in 24 hours on banks? I'm out.
We're not at peak earnings, right? So if we think about the setup, the new setup for next year, fewer rate cuts, right? So higher rates, a burst of activity likely in the capital markets, and a redefinition of excess capital. Who is highly levered to all of that? JP Morgan. And by the way, JP Morgan has the highest dollar amount of excess capital and a relative amount of excess capital in the current regime anyway. And that's, like Jamie says, earnings in store. And by the way, if the consumer is also reset, and we have animal spirits in the consumer, and yes, we're going back to Europe apparently next summer, JP Morgan.
Did cross my mind.
Yeah, JP Morgan and that card growth, right? They're going to be a big beneficiary. So yes, the PE looks lofty, but the E is going to continue.
So you really believe this is like one of those major redefining moments for the outlook?
I do think so, absolutely.
Can we talk about M&A just a little bit?
Yes.
When we caught up with Brian Moynihan earlier this year, he gave us a pretty strong suggestion that there were some companies out there that would be willing to do a deal but couldn't do a deal, couldn't even have a conversation about doing a deal because we don't know if handbag deals can happen, we don't know if airline deals can happen. Do you think we'll get some clarity on that front? Because there's some suspicion that the likes of J.D. Vance are actually quite in line with the approach of what we've seen out of this party and what we've seen from the Biden White House. Do you think there could be a change there?
So a mega deal is different from the consolidation of regional banks, right? So I think that it's not going to be necessarily immediate. Everybody wants to understand who's the captain of the boat in terms of the agencies first, right? But I think the conversations are restarting now. If you think about the environment for next year, we probably are going to have a flatter curve than we thought we were going to have. And all of these regional banks need the steeper curve from the short end coming down to earn more money. And this whole notion that we're going to have great growth in corporate activity, that might not be one-on-one translatable to loan growth because the capital markets are wide open and private credit is still chomping at the bit. And so if you have, a fairly decent year and decent multiples, but not quite the slope in net interest income that we thought we were going to have pre 2 days ago, then that is ripe for boards to say, guess what? Now it's time to monetize my franchise and partner with someone larger.
How much does that really depend on this year, how well things are doing, and frankly, whether you like small cap banks or whether you like large ones?
So we're approaching it in a barbell fashion, right? Because the middle is where all the consolidation is going to happen in terms of who are the new trillionaires, the new trillion-dollar banks, who are the new Category 2 banks. And if you think about the smaller banks, they peaked at a 15 forward multiple in the last Trump trade. They're like at 11 right now, whereas the money center banks are at 13 times. They peaked at 13 times in 2016. So like I was saying, Jonathan, you really need belief that the E is going to go up. So with the smaller banks, the E is going to go up and reset, maybe not as much as we thought, but the PE continues to be depressed relative to where it's traded in the past.
At what point are you looking at just consolidation and the idea of being able to capitalize on the yield curve? And at what point are you looking at banks being at the precipice of a new wave of M&A, not just in banks, but across the board, if the hood is lifted and some of these deals are able to get done?
Yeah, this is why, it may look expensive, but we're not getting off the JP Morgan train. If you think, again, it's so interesting, but it all points back to the money centers, right? Who can take advantage of fewer cuts, greater activity, greater M&A across different sectors? It's the money center banks. They're going to continue to do better, and the E will continue to do better.
You mentioned animal spirits economy. Does that trickle down to the consumer when you have the former president, future president, talking about a 10% tariff weighing 60% tariffs on Chinese imports?
I mean, look, I don't even know how to pronounce it, Shein. Your Shein goods are not going to come.
I'm guessing you're not shopping there.
I mean, maybe we have fewer unboxing videos. But look, I think that it's going to be a close call, right? But if folks are employed, folks are feeling good, right? Maybe spending will be flat, as opposed to what we were thinking about last time we were here, that there's no way that the spend trends could continue, right? All of the spend trends that we're seeing in the card companies have been based off of the issuance of new card, not because each customer is spending more per account.
Because last time you were on, you talked about how maybe the market was a little bit complacent about a soft landing.
Yeah.
When you see these trades put in, is everyone back to no landing scenario?
Yeah, and we were so lucky. We had a meeting with Jamie Dimon yesterday. What fabulous timing. And he essentially said, look, all the conversations we've had so far with corporates are uniformly happy, right? So if corporates are investing more and, job growth continues to be reinvigorated, folks are feeling good about the economy. That might support at least the continued level of consumer spending. I don't see an acceleration necessarily, but a continued level of spending. And by the way, Capital One, JP Morgan, Amex, they all want to give you a card. They all want you to lever yourself, right? So there are ways for you to support that spending next year.
You could sense the frustration from bank CEOs on Wall Street with the regulator. It was kind of boiling over. Do you think they will have some influence on the direction for policy in a Trump administration?
It's always at the margin, right? Because since the global financial crisis, what is, what really sticks out to me is how embedded it is to stick it to the banks in terms of like prudential regulation, the stress test annually. I'm not sure you're going to necessarily have a sea change, but remember, we were going to have a rule that would increase capital requirements by 30%. Now that's going to get cut in at least in half, right? The stress test has been so volatile, perhaps it's not going to be as volatile. And remember, the current regime of the stress test, where the amount of capital you burn as part of your day-to-day capital requirement, started only in 2020, right? So this administration and this new regulatory leadership can put their own stamp on the stress test and perhaps make it less volatile.
So it's not necessarily a bet that things will get better, it's a bet that things won't get worse.
Correct.
Which I guess is a big difference. Erica, it's good to see you.
Thank you.
Thank you so much. Erica Najarian there of UBS on the financials after the biggest one-day pop on the banks on the S&P so far this year and going back several years. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Ukrainian President Vladimir Zelensky said he had an excellent call with President-elect Donald Trump. In a post on X, Zelensky said that they agreed to maintain close dialogue and that strong U.S. leadership is vital for peace. Zelensky had a troubled relationship with Trump in the past, with Trump promising during his campaign to end Russia's war on Ukraine in, quote, 24 hours. Nissan cutting 9,000 jobs globally and reducing production capacity by 20%. The company also downgraded its annual sales and earnings forecast after reporting a quarterly loss. Nissan has been reshaping its global strategy after restructuring its alliance with Renault and Mitsubishi last year. Hurricane Rafael slammed into the western coast of Cuba as a Category 3 storm last night, causing an island-wide blackout. The storm is expected to slow today and meander over the south-central Gulf of Mexico this weekend. Rafael is the 17th named storm of the Atlantic hurricane season and the 5th major hurricane of the year. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, embracing the Trump trade.
This is a broad dollar move. So if we think about it, this is U.S. exceptionalism. So the key tenets of this is basically emerging market currencies are going to underperform. If you go, again, back to Latin America, if you think about the Mexican peso, this is the worst case scenario.
That conversation up next from New York. This is Bloomberg.
in case you missed it on Bloomberg Technology.
We're excited to really change the expectations for space companies where you have this always-on, reliable, and frankly dynamic satellite connectivity that you would expect of your power grid or of your cell phones. And so we think that this is a huge opportunity space, and our first contribution to it is through shared infrastructure.
You can see this whole ecosystem developing, and you have an exponential growth right now because easier access to space means more demand for space, and that's the definition of an exponential growth function. So if you think about someone like Varda, who is only possible now because access to space is cheaper and easier, we're demanding more access to space.
I think that's what's so exciting from a business perspective, is the fact that if you can do it, you're one of a few numbers of organizations in the history who've actually pulled it off. And so it creates a very defensible position, because again, space is very, very hard.
Don't miss Bloomberg Technology live every weekday.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Live from New York City, welcome to the program. Equity futures on the S&P 500 with a little bit of a bounce here, up by 0.2%, building on the big gains of yesterday's session. Under surveillance this morning, embracing the Trump trade.
This is a broad dollar move. So if we think about it, this is U.S. exceptionalism. So the key tenets of this is basically emerging market currencies are going to underperform. If you go, again, back to Latin America, if you think about the Mexican peso, this is the worst case scenario. With the euro, again, we have uncertainty around German government, which is likely to collapse at some point in the near term, and we're looking at potential elections in Germany. So there's political uncertainty in Europe and growth for violence coming through in the U.S.
What a call from Mark McCormick in yesterday's session. Here's the latest this morning. Donald Trump's presidential win sending the US dollar to its biggest one-day gain against the euro in more than 4 years. Skylar Montgomery-Koenig of Barclays writing, our previous work on the first order FX moves of the election solely looks at the impacts of tariffs, as these could be imposed through presidential power. Our model shows an asymmetric skew in favor of the dollar on a Trump win, with euro dollar reaching towards 103. Skylar joins us here in New York. Skylar, it's good to see you. And welcome to New York City.
Thank you.
Away from London. Let's talk about this trade. So this trade down to 103s on tariffs exclusively.
Absolutely, yeah.
When do you start to think about taxes and interest rates at the same time?
Well, you think about taxes and interest rates already, right? We've had this big shift in the narrative around the dollar, and I think this is really important to put the Trump trade into context, is the shift in the dollar was before Trump. It was because we had a very strong non-farm payrolls. That fed into strong growth expectations, it fed into a less dovish Fed, and that was the start of the trade. And so we still have a gap to close on euro dollar down to rate differentials that was motivated by growth differentials as well as by the Trump trade itself.
So is this a parity call now?
I don't think we're quite at a parity call. I think we still need to see whether we get the House. On tariffs alone, as you say, we can get to 103. That's what our model tells you. On confidence effects, on import substitution, et cetera. If you get the fiscal and you get some kind of boost from that, it depends on how big that is. That can certainly add to dollar upside.
You said that the strong dollar already takes into account interest rate differentials and growth differentials, and yet what we've seen across the street, people downgrading their expectations for the euro region, people expecting the ECB to lower rates even further, and the opposite in the United States. Have we truly priced that in to the euro at this point?
No, absolutely not. I think certainly there's a gap that's opened up between interest rate differentials and the currency, and that needs to close down. I think part of it, too, is we have to reevaluate our expectations of the Fed. We've had a lot of dovishness come out on the growth outlook alone, but we don't really know what the growth outlook looks like now because we don't know exactly what Trump can do on fiscal. We don't know what he can do on taxes. And so that still needs to feed into the outlook for the Fed. And we're still debating kind of when the Fed skips now. That's a very big change in narrative from thinking that they're going to cut 50 basis points again.
So do you think that even just based on that differential, the euro needs to weaken before tariffs even get implemented or taxes or some of these other proposals?
Yeah, absolutely. I mean, certainly that should feed into more downside.
So 103, but not parity yet?
Not parity yet.
If there is a sweep across the board, which is the vast expectation in betting markets, Does that get you there?
I think we need to start thinking about it. The one thing that makes me hesitant is the fact that last time around we got this big move up in the dollar, and we're actually pretty much following the path that the dollar took in 2016 into and out of the election, and that implies that you get a big wave of dollar upside from here. The issue is, when do you actually get the fiscal? So last time around it took around a year to actually get fiscal. You wanted the fiscal before you did tariffs because you were worried about the growth impact, and so we didn't really start thinking about tariffs until 2018. So yes, this big wave now, but we could have this hesitancy in the middle if policy action doesn't come through quickly.
Well, the one hesitancy might be the debt ceiling fight. That's January 1, and we probably won't get a tax bill to the very end of 2025 or early 2026. So does that hold the dollar back? What kind of range is that?
I think because we have a fundamentally strong backdrop for the U.S., there's lots of cases for why U.S. exceptionalism is here, in terms of you have a high return on capital, it's a closed economy, they have energy independence, there's not really an alternative in the U.S. and China. And so because you have that strong growth backdrop, that alone is a fundamental support. But yes, in order to get significant upside, I think you need to have
to get to parity. Do you just need the collapse of the German government, which we pretty much have?
I don't think we quite need that. In terms of Germany, it's been in a poor state for a very long time, right? I think that's largely priced in. Obviously, it can get worse. Political noise can make things a bit more dicey for the currency, but I don't think that's why we've seen the move in yields or in the euro.
It's bond supply on the ballot in Germany. And I think that's something we've really got to think about now. Yesterday on the programme, we were talking about the divergence in fixed income. US rates up, German yields lower. Today, German yields are a little bit higher. I think there is an idea that perhaps bond supply is on the ballot. I'm not sure how the Germans might feel about that. How do you think about that, the German election, and what it could mean for the prospect of maybe just looser purse strings in Germany?
I mean, I think that would be very good for the European Union, right? The issue with Europe is that you can't get fiscal cohesion. Because the U.S. has fiscal in a way that no one else has, they just kind of don't worry about issuing debt, and that means that they can stimulate the economy. It gives them an advantage over Europe, whereas Europe, because you don't have that fiscal cohesion, you're not stimulating. And so if Germany comes to the table, that gives more leeway to your periphery economies, to France, who's already kind of in trouble, and so it should be a positive.
Can we venture outside of G10 just for a moment? Do you know what was the peso mystery? What was that yesterday? Because overnight, literally, 7:30 Eastern time, election night, this market makes a move, never looks back. And we were looking at three things: equities, outperformance in small caps, rates, yields up big time, and then in foreign exchange, the peso getting absolutely hammered. And then by the end of trade yesterday, the peso was strong. What was that about?
Yeah, it's quite a weird move. I think I put it down to the market thinking that Trump was almost fully priced. As in, we went in, and all of the commentary that I was hearing prior to the kind of Harris pullback last week was that Trump was almost fully priced. And so if people are profit taking, or if they're worried about the prospect of getting higher, then that comes in. I also think the risk move is important to think about, because the risk move depends on whether you get a house. So if you get the house and you can do fiscal, that's growth positive, that feeds into cyclical currencies like EMs more positively. So I think it's in part profit taking, this pullback from the Trump trade, and then also in part you're having a more positive risk backdrop if you're stimulating out of the US.
I'll run with that explanation. It's good to see you. Thanks for catching up with us. Skylar Montgomery-Koenig there of Barclays, looking for a move on euro dollar down to 103, and a rethink if we do take the House and we clean the Republican sweep.
Yeah, well, and this is really ultimately the question of how far can this divergence go. I'm still thinking about the peso. I'm sorry, I'm distracted by the peso, because I'm wondering, it kind of crystallizes this feeling, how much do we really understand how far these trades have to go? How much has the threat of it alone maybe made Claudia Sheinbaum, who's the president of Mexico, actually want to negotiate in a more significant way, considering that they've already raised questions about Chinese imports? These are some of the things that I think are the sort of non-easily priced aspects.
We'll continue discussing them. Up next on the programme, Stuart Kaiser of Citi, Tobin Marcus of Wolf Research, Dana Peterson at the Conference Board, and Congressman French Hill of Arkansas on the outlook for Republican policy. From New York, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar, they're leaders in EVs, they're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries, and those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
There is concern about higher inflation, and there is also a revisiting of the conventional wisdom of the Fed.
Rates in the long end are going up for reasons that have nothing to do with Fed expectations.
The problems are only going to get more acute.
What we're going to have in the U.S. is clearly policy discontinuity.
A November cut is effectively a done deal. December still very much up in the air.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Just frame how interesting this morning actually is. A little bit later on this afternoon, the Fed's likely to cut interest rates by 25 basis points. The Bank of England just did. But for financial markets worldwide, it hardly touches the sides. It's not really being discussed because there is a real belief that after the US election, we have totally redefined the outlook for policy, for the economy, for interest rates, particularly stateside, and maybe even abroad as well. On the S&P 500, equity futures up by 0.2% on the S&P. We're at all-time highs. Record highs on the Nasdaq 100. We had some weight to that move, up by 0.2%. And here come the small caps all over again. Lisa, up 0.7%.
Just building on what you said about new regime, there is this feeling that central banks are still reeling from the reality that financial markets are feeling in real time, which is, as you said, the perception of a growth shock. It's not what we're projecting, but that is basically what the market is saying. Here is the question. How much are these central banks going to reflect the increased possibility of inflation because of budgets that have been expanding? This is the first Bank of England rate decision after that budget was released by Rachel Reeves. Curious to see what kind of nods we get to that, both by them as well as by the Federal Reserve.
And there's been this recalibration in the financial markets because there's no gray area. Donald Trump won with a mandate. Yes, we're waiting on the House, but at this moment, you would rather be Speaker Mike Johnson than Hakeem Jeffries because it's likely going to go your way. And the Republicans are set up for Trifecta.
We've got a lot to get through this morning, so let's get to it. Your next hour looks like this. Stuart Kaiser of Citi, as markets embrace the Trump trade. Tobin Marcus of Wolf Research on a post-mortem for the Democratic Party. And Congressman French Hill as the GOP looks poised to complete a red sweep. As I mentioned just moments ago, the Bank of England decision just crossing. Let's head over to the UK and catch up with Lizzie Burton of the Square Mile. Lizzie, good morning. That decision to cut interest rates, give us the complete picture. What does it look like this morning?
Well, John, this is a hawkish cut from the Bank of England. It is what we expected. A quarter-point cut was as all 54 economists in our survey expected, given that inflation is back below 2%. But the focus is on the path ahead here. You've got a vote split 8-1. That's what we expected. Catherine Mann, the sole dissenter, in her own words, on the hawkish side of things. But on the forecasts for the path ahead, they've now factored in Rachel Reeves's budget. OK, so it is too soon to factor in Donald Trump's victory, but they're saying that this is going to be inflationary, the budget. Traders had priced in fewer BOE cuts because of the fiscal loosening, and indeed, the Bank of England is saying that inflation will be higher because of what she has done. I will note, John, this is based on a pre-budget yield curve. So after the gilt moves that we saw, since Rachel Reeves sat down, we've seen actually all of her headroom wiped out, and actually it looks like more tax rises are on the horizon. But look at this forward guidance here from the BOE, maintained. They can't cut rates too quickly or by too much. That dangling of hints about more aggressive policy from Andrew Bailey seems a long time ago now.
Lizzie, appreciate the update. Thank you, and looking forward to your coverage in the United Kingdom through today. Lizzie Burton there of Bloomberg outside the Bank of England. What Lizzie just said there is really, really important. Even if you're not interested in UK policy in the Bank of England, even if you're based here stateside, what just happened in the UK is an appetizer for what might happen at the United States Federal Reserve. What, 6 months out? Early March?
They are able to take a look at the fiscal budget, the preliminary one that was proposed by Rachel Reeves over in the United Kingdom, and they assess that that budget lifts inflation by just under 0.5 point at its peak. So here's the question. How much is this something forecastable? How much is England and Andrew Bailey in a world of his own when it comes to how you deal with this versus Chair Powell and how he deals with it to try to seem less political? But it really does show how much the fiscal budget and how much fiscal changes can completely alter the path for some of these central banks.
Let me put it this way. That news conference we get this afternoon will be on another planet compared to the planet the financial markets have been on in the last 24 hours. We've completely redefined the outlook for 2025, and Chairman Powell's going to be looking at dot plots from September 18th. I mean, just think about how redundant this conversation is going to be today.
How much can he make it redundant and boring as possible, because that is going to be the goal. At a certain point, what does data dependency mean when the data really relies on the other side of the equation, which is the fiscal aspect?
We kick off this hour with equity markets at all-time highs going into today's Fed decision after the S&P 500 posted its best election day in history. Stuart Kaiser of Citi saying the equity bull case was and remains solid US economic growth buttressed by FOMC insurance cuts back towards neutral. In that framework, cuts being priced out was good for equity markets. Stuart joins us now for more. Stuart, good morning.
Good morning. How are you?
What changed for you yesterday morning?
What changed for us yesterday morning? You know, not a ton. I mean, it's the market's reacting really positively to what they view as a positive growth impulse. But also, frankly, this is just a relief of getting past a major event risk where, clients had significantly de-risked going into that event as well. So, our view on this is kind of stand back for the next day or two. We're not gonna fight this rally. We're gonna kind of see where positioning and views kind of rebase themselves. And I think kind of early next week we'll take a much closer look at the moving parts. But look, the clearest trade yesterday was stocks that benefit from financial deregulation were up double digits. Renewable energy was down double digits. And I think that tells you everything in terms of how the market is kind of approaching the Trump trade.
We spoke to Laurie Calvasina from RBC a little bit earlier, and this is how we cut it up. Basically, tariffs, taxes, regulation, banks flying, taxes, the prospect of a sweep, yields up big time, tariffs, consumer-facing companies, we saw Dollar General get hammered. Target struggled just a little bit in a very strong up market. How are you thinking about those companies into 25? Because we don't have to hang around to see what happens with the House. we know we're probably going to get some tariffs.
Yeah, to me, the tariffs is the hardest one to kind of unpack. I mean, you don't know where he's going to tariff, how much he's going to tariff, and which companies are going to be the most impacted by that. So I think that's a little bit of like thumb in the air of, yeah, we think it's going to hit consumer spending, we think it's going to hit these other areas. So, you know, to me, that's just, it's a little bit of a wild card in terms of identifying those companies specifically. I mean, if you listen to some of his proxies, they view tariffs as really a negotiating tactic. So, you know, what are you going to extract from both our allies and our competitors with those tariffs as well? Anyway, I think that's a very, very hard trade to put on. And I think what a lot of people are doing is just saying that's going to flow through to Fed policy. That's going to flow through to the inflation outlook. And I'm going to kind of trade that impulse as opposed to, you know, trying to like, you know, tick and tie each stock that might be most directly impacted by it.
So let's go there. You put out a number of really wonderful notes in the lead up and after the election. And one of them you said was the biggest risks to the rally that we're seeing right now. Number one, a weaker growth outlook. And number two, benchmark yields that really get to be punitive with respect to valuations. Which of the two are you most worried about right now?
Tactically, it's the rates part of it. I mean, if you look at what's happened to the real yield curve, so that sort of term premiums expanded meaningfully. Nominal yields, I think, are getting to levels that are getting people's attention, you know, without a doubt. The market was willing to kind of digest that weak labor report, and we're not going to get, you know, obviously an update on that for a month or so. But I think tactically speaking, the biggest risk to this rally is you just get a dislocation that long end of the yield curve.
So do you have a benchmark? Is there something that's sort of the tipping point where it becomes more noticeable other than, yeah, I guess I should pay attention to that at a certain point, but I'm going to keep buying small caps?
Look, it's tough to put a number, like, you know, yields need to get here, yields need to get there. I think the bottom line is it's bond volatility is really going to be the initial thing. But look, if you put the 10-year yield at, you know, 4.75 on Monday, you're going to get, you know, the equity market, you know, kind of responding to that. So I think it's two things. It's absolute level of yields. It's what's going on in that bond term premium. And in particular, how volatile are those yields? Like yesterday, for instance, the 10-year got up to 4.45. And then kind of, you know, move sideways for a bit. And I think that actually helped equity markets, that you didn't get the inflection higher. You got a little bit of stability in the rates market.
But at some point, doesn't that break? Because if you have higher yields, how much higher can these small caps actually go?
Yeah, look, I think, you know, small caps benefits, frankly, from a little bit of low liquidity overnight. I think that really helped it. What was really interesting in small cap yesterday was not only did small cap rise, but profitable small cap outperformed significantly. So not only was it people like, let's say, blindly buying that theme, they were actually within the space, you know, trying to buy the sort of best and brightest of that small cap. Look, I think for now, small cap is really benefiting from the growth impulse and the deregulatory part of it. But to your point, it is, excuse me, it is much more rate sensitive. So that is the part of the market that, you know, kind of is on the firing line if we do get a dislocation.
So right now, it seems like the market is pricing in all of the good things that could come from a trifecta down in Washington. And you say that they're uneasy about the tariffs. But if you take Trump at his word, it is 60% on Chinese imports, 10% from everywhere else. What does that actually mean to some of these consumer-facing companies?
Look, if you went through with all of that, then, you know, that is clearly negative for consumer-facing companies. I mean, that money needs to come from somewhere, right? So, yeah, look, taking it at face value, which I know is what a lot of people are trying to do, is would read negative for markets, at least initially. And, you know, we need to see kind of how that flows through and what happens. But yeah, if you instituted that type of tariff right up front and you follow through with it, yeah, that is negative for that part of the economy. I think what the market is telling you is, one, positioning was light. We have to deal with that first. Second, I think the view is that's an opening bid, you know, meant to extract concessions, and he's not going to.
Depends who you ask.
No, I agree 100%. Look, but, you know, like Trump is someone who is sensitive to financial markets and is sensitive to economic growth. So, you know, will he dial back that rhetoric if you start to see the markets moving the other direction?
You just need him to quote the S&P and stop this Dow Jones stuff, and I hope we can move on in Trump 2.0. I'll lobby this administration to do so. Are you going to watch the news conference with Chairman Powell later? Is that even worth watching?
I definitely have to watch it.
Why?
Have to watch it. Because, you know, to your point on, you know, what's going to happen in March and 6 months from now, I think there's signaling involved there on how they're going to approach.
You think he has to start signaling?
No, I don't think he's going to, and I don't think he wants to, but he's going to get asked the questions, and you know, those questions are relevant, right? I mean, you have less than 3 cuts priced in calendar year 2025. You have less than 3 cuts now priced through the balance of this year. He's going to get asked those questions, and the question, you know, how does he respond to that? What is the body language? I mean, I agree that in an election week, they want to be as quiet and milquetoast as possible, and I think they're going to go down that route. But he's going to get asked the questions, and the question, you know, the proof will be in how he answers those.
It's a kind of bizarre moment, isn't it? And we've just seen this with the Bank of England. The Bank of England has to basically look at the prospect of a much more inflationary UK off the back of a budget. What we could see here in the United States might be that on steroids. And they're going to cut interest rates today and maybe signal they want to do the same thing in December. Isn't this kind of bizarre? We've got these two very different planets that we're all sitting here talking about Trump policy and scenarios for 2025. And the Federal Reserve's pretending the election never happened, and they're basing their projections off what they said in September at that meeting.
Well, I mean, Nathan Sheets at Citi used to sit in those meetings, so he gets to go to the big boy table. And basically what he told me is, A, they are apolitical, and B, they are not going to prescribe policy ahead of time based on what might happen from a political decision. So you're just not going to see them step in that bucket if they can avoid it. And Tom Keene likes the Dow, John, so you should really...
I know, it's a fight. It's an ongoing fight, and that ongoing fight's going to continue. Tune in for special coverage of that Fed decision. TK will be here, and we'll no doubt have that conversation. Stuart, it's good to see you. Good to see you. Appreciate it, sir. Stuart Kaiser there of Citi. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just a quick recap of that BOE decision. They cut rates for the second time this year, lowering its benchmark interest rate by 1/4 point to 4.75%. The bank warns that the UK's budget will drive up inflation by as much as 0.5 percentage point. 8 members of the MPC voted to lower rates. Catherine Mann, one of its external officials, was the lone dissenter. Airbus needs to almost double its monthly deliveries in the last 8 weeks of the year in order to meet its annual guidance. It delivered 559 planes as of October. That leaves it with 210 to go. Airbus has been struggling to build aircraft fast enough. Suppliers, they've been also struggling to ramp up production since the pandemic. And spirits are high in Cleveland with the Cavs off to their best start in franchise history. They beat the New Orleans Pelicans last night to improve their record to 9-0, boosted by a 29-point night from Donovan Mitchell. Elsewhere, the Golden State Warriors beat the defending champion Boston Celtics behind a vintage performance from Steph Curry. Curry hit 4 threes along with 9 assists and nearly notched a triple-double. And that's your brief. John.
Danny, thank you. More from Danny in 30 minutes' time. Up next on the program, the election, post-mortem.
I spoke with President-elect Trump and congratulated him on his victory. I also told him that we will help him and his team with their transition, and that we will engage in a peaceful transfer of power.
That conversation up next, live from New York. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Equity futures on the S&P 500, little bit of a lift, up 0.25%. All the drama was yesterday. Some of the trends continue, though. Yields creeping a little bit higher. The 10-year 443.54. Looking at crude, we're down 1%, 71 on WTI. Under surveillance this morning, the election post-mortem.
The outcome of this election is not what we wanted, not what we fought for, not what we voted for. While I concede this election, I do not concede the fight that fueled this campaign. I spoke with President-elect Trump and congratulated him on his victory. I also told him that we will help him and his team with their transition, and that we will engage in a peaceful transfer of power.
So here's the latest. The Democratic Party searching for answers after Donald Trump's decisive victory over Kamala Harris. Democrats losing the majority in the Senate after dropping 3 seats to Republicans, with the race for the House still in the balance. Tobin Marcus of Wolf Research writing, Dems now find themselves in the wilderness with big debates ahead about how to rebuild. And on the GOP side, presumptive VP-elect Vance instantly becomes the frontrunner for the 2028 nomination. It'll be an interesting few years in Washington. Tobin, it will be an interesting few years worldwide. It's good to have you back, Sarah, and thank you for your coverage on election night with us. I want to start with the Democrats, and this line from Vice President Kamala Harris. Whilst I concede this election, I do not concede the fight that fueled this campaign. Tobin, I can think of very few demographics that would like her to continue this fight, given the shift in support that we saw towards Donald Trump. Do you think the Democrats will learn the right lesson from this beating?
I think that, look, this is going to be a vigorously fought question about which direction the Democratic Party should go. And I think that the next primary campaign is going to be the forum for that fight. But the comparison that keeps coming to mind for me is 1992, where at that point, you were coming off of 12 years of Republican governance. Reagan had engineered a broad realignment of the electorate. And what ended up happening was you had Clinton coming in, not just running against Washington, but really running against the Democratic Party and trying to brand him as a new kind of Democrat. So I think that is the move, for a governor or somebody to, to articulate kind of a critique of the direction that the party's been going for a while now, and to have that become the new banner for the party. So, what that is and who that is, I think remains to be determined. But that, I think, is the clear template for how the party, should move forward. And I think there's momentum for that.
Tobin, for me yesterday was the quote from Senator Bernie Sanders. It should come as no surprise that a Democratic Party which has abandoned working class people would find that the working class has abandoned them. He goes on. First, it was the white working class. Now it's Latino and Black workers as well. While the Democratic leadership defends the status quo, the American people are angry and want change, and they're right. Do you see this Democratic Party becoming more right because of this win, a trifecta nearly by the Republican Party, or do they go more progressive?
So, again, I think that is going to be litigated. I think certainly the progressive wing of the party, although it's not clear who their standard bearer will be, I think is going to attempt to make the case that they really made in both 16 and 20, that the way for the party to move forward is to sort of move against quote-unquote neoliberalism and sort of take up this very, thoroughgoingly progressive lefty stance. So it's not surprising that Sanders' take. I don't think that's going to be the consensus across the party. And I don't really think that the broad wave against the Democratic Party that we saw on Tuesday was economic in nature in that way. Obviously, there was a huge amount of dissatisfaction about the economy. Around the world, we've been seeing incumbent parties get just absolutely destroyed in the wake of the inflationary outbursts of the past few years. But I think it's hard to look at the pattern of results and see that as people kind of crying out for a progressive vision. I think that there's a broad sense that the Democratic Party's values are out of touch with normal people. And I think that that's at least as cultural as it is economic.
You mentioned this question of who the standard bearer is. I mean, even in this moment, Kamala Harris gave a speech and didn't really thank President Biden the way most people would expect. At the same time, President Biden is calling President Trump and organizing a meeting with him. It's very difficult to understand what exactly is even going on in the White House, where this relationship is right now. Do you have any understanding?
I mean, look, there's a huge amounts of continuity between the Biden and Harris camps. I mean, just look at the campaign. That being said, Harris does have kind of her own people. So it makes sense that we're seeing different messages from each of them. At this point, the kind of Harris campaign apparatus is not particularly relevant. The Biden White House needs to actually do the transition. There are concrete things that need to happen to hand power over to Trump, and I think that'll happen in a basically normal way. But in terms of the political future of the party, I think that the different people who have their eye on 2028 are going to start setting up their own apparatus and carving out their own kind of power centers, rather than, I mean, we've really had a lot of kind of party elites trying to guide the party through something from 2020 onwards. The coalescence around Biden during the 2020 primary was a sort of unusual degree of sort of centralized steering relative to what we normally see, which is kind of political entrepreneurism with, again, sort of charismatic outsiders coming in, trying to shake things up and taking over the party for themselves.
Tobin, there was an incredible statistic from Jim Reed over at Deutsche Bank that really crystallized how unique this moment is. He said that it is the first time since the late 1800s that the incumbent party of the White House has lost 3 consecutive presidential elections. So yes, this is a Democrat versus Republican issue. This is a question about the identity, but there's something else afoot. Can you give us some color onto why we're seeing this type of trend?
Yeah, absolutely. I think that the explanation for that is that we are on a multi-decade secular decline in the share of people who say that the country is going in the right direction rather than on the wrong track. So incumbency traditionally has been an advantage. The more that there is a persistent feeling that America is going in the wrong direction that transcends who particularly is in control, the more incumbency becomes a burden, and the more that you should expect sort of faster move of the metronome back and forth between parties. That's not to guarantee that we're going to have another, one term of partisan control with Democrats winning back in 2028. But, we are going into another very unusual period where the president who just got elected is a lame duck. So Trump is not going to be up in 28. As you, the sort of quote that you ran at the top from my last note, I fully expect Vance is going to be the most likely, but not guaranteed, but most likely nominee for Republicans in 28. We'll see who's running against him on the Democratic side, but I think that will be another opportunity for both parties to try and tap into the discontent of American voters and argue that they're the ones to lead us in a new direction.
As all the exit polls come together, as we do have the results, what's your sense of what the main issues really were that fed into that discontent, that sort of secular decline that people feel across the United States?
I think you have to look at inflation. I think you look around the world and see, parties really of every ideological orientation getting they're having it handed to them by voters around the world. Generally there's some, sort of rising strength on the far right, but I think in many cases that's because the incumbents happen to be on the center or the center left. In places where we did see more right-wing parties in power, whether that's the UK or Poland, we saw backlash against them also. So I think that, it seems to me that whoever is presiding over, first and foremost, this period of high inflation, to some extent, discontent about immigration, which also has kind of, spanned national lines across the Western world. Those, I think, are the most salient elements of people's dissatisfaction about the status quo that voters are rebelling against.
Hey, Tobin, good to catch up. Tobin Marcus there of Wolf Research. Appreciate your time. I don't think it's ever one single reason why you lose an election, and certainly all year we've been talking about the challenge to the incumbent in a post-pandemic world. I would pick out one county that speaks to a much bigger, more important story, though, for the Democrats. The Democrats are finding themselves offside with the center of gravity in this country. The liberal, progressive way of thinking, their ideology, is offside with the center of gravity in this country. Pick out one county, and I'm sure you can all cherry pick your own and tell your own story, but Starr County in Texas, on the border with Mexico, 97% Hispanic, hasn't voted Republican in more than a century. Back in 2016, Donald Trump's vote share was 19%. It was closer to 60 on election night. That's the problem for Democrats. This is not just white Americans, and I've heard this a lot internationally, that this is somehow racism, and there will always be some racism in society, but it goes beyond that. It's almost every single demographic, Latino, Black, Asian. That vote increase for Donald Trump was pretty pronounced.
Every single demographic moved to the right except the electorate that is 65 and over and white women with college degrees. Everyone else, massive shift to the right.
It's a big, big challenge to the Democratic Party. Coming up on this program, Dana Peterson of the Conference Board looking ahead to today's Fed rate decision. That Fed rate decision later this afternoon.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Let's get back to the market. Equity futures right now up by 0.25% on the S&P 500 after a really strong rally in yesterday's session, up 0.4% on the Nasdaq, and once again some outperformance on the Russell. The small caps up by 0.75%. Earlier on this morning, Lisa asking all the right questions as always. In the bond market, at what point do high yields become a constraining force around this equity market, Lisa? And so far, not in a big way.
You know, and Stuart Kaiser put it well. He said it's really bond market volatility and the uncertainty of how high yields could go. Yes, if the 10-year goes to 4.75 overnight, suddenly you start to have a problem in small caps and the rest of the market. However, the fact that you've seen a stabilization, and frankly, I would add, a pretty successful 30-year auction, albeit at much higher yields, gave people the confidence that it's not up and away, it's just a reset.
Futures higher this morning with 2 hours until the opening bell with your morning movers. Here's Manus Cranny. Hey, Manus.
Jonathan, good morning to you. Day two, weaponized FOMO wherever you look. Lyft raised their guidance for the year. Look, this is a minnow compared to Uber, but just take a look at that, up nearly 25%. They're going to get autonomous vehicles in the offering next year. Record number of trips, record number of riders, and commuters make more than 50% of the customer base. Why? Because they put in a price lock. In other words, you don't have to deal with that price surge. So it's a snapper at the heels of Uber, but it's certainly one to reflect on. Qualcomm on the tech side, the stock is up 20% so far this year. We add nearly 6%. They've got a nice bullish guidance for the year. This comes down to how do you see the progression of the high end of the smartphone from Apple, the Apple 16 Pro, and then you look at what's happening with Android in China, and this is where JP Morgan say the language around this is good. Android market is building and has solidity in it, so to that extent, a nice future. And it's also about diversification. The auto tech and the Internet of Things also doing very well in the readout from Qualcomm. Let's finish off with your COVID vaccine. Hasn't gone away, up 9%. They got an early agreement on their new COVID vaccine. That's pushed their sales through and up on the higher level. The CFO says that, of course, that market is durable and a sizable market. They're going to make $3 to $3.5 billion in sales this year, and they have a packed pipeline. 10 new products in the pipeline. Jonathan.
Manus, thank you. I'm pleased you brought up that story. I think it's quite relevant to the election conversation we'll have in just a moment. Under surveillance this morning, Vice President Kamala Harris conceding to President-elect Donald Trump. In a speech from Howard University, Harris pledging to help with the transition for a peaceful transfer of power. President Joe Biden addressing the nation at 11 a.m. this morning. How different will that speech, that address be?
Well, it's going to be interesting because he's clearly going to try to unite the country. He's going to say they want to have a peaceful transfer of power. Two things struck me yesterday. One, we haven't had a real concession speech because Donald Trump did not give them this grace when he left office, when Biden came in. But that 2016 concession speech from Hillary Clinton sounded a lot like Kamala Harris's speech yesterday. What's going to be more interesting is the fact that, and I spoke to some people around the former president yesterday, there does seem to be this meeting that is going to happen before Trump takes office. He is going to go in and sit down with Joe Biden. And I think that is going to be very interesting. And the Wall Street Journal today editorial board says Trump has this second chance. How he uses it is going to be incredibly interesting. Does he try to unite the country himself, or does he go after grievances?
I gave a little bit of a teaser when Manus Cranny was looking at Moderna. How much influence do you think RFK is going to have over a vaccine policy in America?
I mean, it depends who you ask. RFK thinks that he's getting control of a ton of agencies and people. Other people, not so sure. Also, it depends how the Senate shakes out, who Donald Trump can get through for cabinet positions. So, of course, the GOP has control of the Senate, but is it going to be a 52 majority or 54 majority?
There also is this larger question of the people he puts into place will really determine whether it's an issue of sort of transactional types of policy or something more comprehensive, because there are some people who are advising him who are longtime people in business and have experience coming up with a much more sort of disciplined strategy, and other people who are less so.
Speaking of business, big tech executives lining up to congratulate President-elect Donald Trump in the last 24 hours. Amazon's Jeff Bezos, Meta's Mark Zuckerberg, and Apple's Tim Cook all offering messages of support. The industry preparing for the new administration and potential changes to regulation.
So, Jeff Bezos has tweeted twice this entire year, and both tweets were about the former president. July 13th, after the former president survived that assassination attempt in Butler, Pennsylvania, and yesterday, big congratulations to our 45th and now 47th president. But we had seen this from tech executives leading up to November 5th. They were all having these check-in calls, making sure that they were on side for potentially Trump winning the White House. So no surprise there, but it is interesting. The only time I've seen Jeff Bezos make these public tweets was when it had to do with Donald Trump.
What kind of changes are they expecting? What kind of favor are they looking for? Are they just hoping that things won't get worse, or were they worried that the president, the former president, now president-elect, is going to actively come after their business? And when I say those words, I'm thinking more about Meta and Mark Zuckerberg than I am the others.
So there's a question about the antitrust aspects of this and what kind of actions they could have. But there's also the China issue. Could you get carve-outs for specific areas, especially if the tariffs are going to be pushed up pretty significantly on Chinese goods?
I agree with Lisa. I think first on their mind is the FTC. These guys want to see Lena Khan out. They all want to see her basically leave, and they want someone, even if J.D. Vance has said in the past, Senator Vance, talking about that he thinks Lena Khan has done a decent job. Everyone I talk to says, well, that's nice if J.D. Vance offers opinion, but it's up to the former president. And we do know how Trump feels about deregulation. And then second, of course, has to do with this idea of you're only going to get that 15% corporate tax rate with conditions. How much of your products are going to be made in America? And are there going to be things like carve-outs?
That's the tech sector. Let's talk about the automakers as well. Stellantis laying off 1,100 workers at a Jeep factory in Ohio. The automaker pointing to bloated inventory and declining sales. U.S. deliveries for the third quarter falling to their lowest level since 2021. And once again, the future of White House policy is going to be at the epicenter of this industry.
Yeah, in a big way. First of all, from EVs and regulation and what sort of the new protocols will be, but also with respect to tariffs and how much the U.S. market is insulated from others. I do find it interesting. And Stellantis, this has been a long-standing issue, and they've been trying to deal with it independent of Trump. There is a question, though, what kind of pressure there'll be to come to the United States and build the cars here, and what kind of penalty there will be from the likes of a Trump administration for an auto manufacturer that closes a plant or has pretty big reductions. It's sort of this interesting tug of war about which is better for companies or worse for companies going forward.
All of a sudden, executives who are on the brink of making big decisions about where factories will be, how much staff they want, have got an extra thing to worry about when they go to sleep at night. It's waking up in the middle of the night with the phone buzzing because the President of the United States has put out a message going after your company. That is going to keep them on edge. I don't know how much will influence the ultimate decision they have to make, but it would certainly be a factor.
Well, leading up to the election, Elon Musk had said on earnings call that he was, even though we do know he's obviously a friend of the former president, he's been at Mar-a-Lago hanging out with the former president, future president. He has said that he's on hold on what he's going to do with his Mexico plant until after the election. We already heard from Donald Trump about what he thought about Deere. And if they go through with making more of their tractors in Mexico, they're going to have to deal with tariffs. I think that Stellantis news about job cuts in Michigan that made sense to me in terms of when you look at the map in Michigan and why it moved to the right and voted and flipped it back to red from 2016 Donald Trump to 2024 Donald Trump.
Tom Naran of RBC will join us in about 30 minutes' time, so look out for that conversation on the autos. Let's turn to the Fed. We've hardly talked about it. Markets looking ahead to a 2 p.m. rate decision, followed by a Chairman Powell news conference 30 minutes later. Dana Peterson of the Conference Board writing, the results of the US election likely will not affect the November interest rate decision, but it may alter the pacing of future interest rate cuts. The setup for the backdrop for a 25 basis point cut in November and likely also a 25 basis point cut in December. And then it's on to who knows. Dana, welcome back to the program. And I want to lead with just a thank you for joining us late in the night on election night. We appreciated your time. Dana, I wonder from your perspective, because you measure confidence so well over at the Conference Board, how do elections like these, seismic events that people do believe redefine the outlook for the economy, how do they influence confidence in the near term?
Well, it's really about how it impacts employment, your pocket, and certainly when we look at our consumer confidence measure, consumers, even though they notice that inflation has slowed, they're still complaining about prices being elevated. And so if they get the sense that, yes, they will continue to work, but prices will fall, then they may stay optimistic like we saw in October. But again, it really depends on what the outlook looks like. And also they're looking to next year in terms of the tax cliff. Will they see their tax rates rise?
Dana, before we look into the future, can we look back into the past? What did we learn from 2017 tax cuts, 2018 trade war? How did that shape both consumer and business confidence back then? And do you think you'll see similar things this time around?
Sure. Just starting off with businesses, the tax cuts many businesses were ebullient. They were really happy about that. Some did issue $1,000 checks to the employees and raise wages a bit. Some did say, yes, we're going to invest more. But for the most part, we saw that businesses, were giving back money to shareholders. And when it comes to workers, certainly they were happy to see their tax rates fall. So fast forwarding to next year, any changes in that dynamic is going to be material for businesses and especially for consumers. If consumers see that now they have to pay higher taxes, then they're going to pull back on consumption, and that's going to impact businesses.
Even sooner than that, though, can you just give us a sense of how much the boom that we're seeing in equity performance right now and this feeling that there is going to be a new wave of growth, again, not necessarily a forecast, but the implication from the markets, how much does that alone give a real boost to consumer confidence and consumer spending?
Well, consumers do equate the health or the strength of the equity market as reflecting back on them. Even though most people don't own stocks, they see it as well. The business conditions are favorable. However, will they change their minds? Will markets change their minds if we start seeing a renewed trade war? Yes, some of the tariffs that were put in place in 2018, 2019 are still with us, but will we see more? And certainly that means higher prices for consumers because the price of those imports will be higher. Businesses will pass that on, certainly through inputs, and consumers will feel it immediately through finished goods. So let's see what markets think if we do have another round of trade wars or even shocks to geopolitics that cause commodity prices like food or energy or even important inputs like metals and critical earths and computer chips affecting the economy and consequently inflation for consumers.
In the meantime, Dana, this brings us to the Fed and how the Fed considers markets. In the past, when markets go down, the Fed considers it. When it goes up, they shrug it off. That's been sort of the theme that we've seen pretty consistently. It's going to be an awkward meeting today for Fed Chair Jay Powell to not talk about the elephant in the room. But does he have to address what the market is saying about the potential path of inflation, as well as just this sort of feeling that maybe there is going to be stickier growth that's going to be reaccelerating?
Well, Chair Powell's going to have to do two things today. He's going to have to talk about what's transpired since September. And certainly the data had been more or less favorable. We did have that odd October employment report, but we know that that was affected by strikes as well as hurricanes. But for the most part, the U.S. economy is doing great. A little bit of stickiness in core inflation, so that would justify a 25 basis point cut today, and then potentially also in December, because we're not going to see many big policy changes until next year. But certainly the second piece of this discussion has to be about the outlook. And there is a potential that the Fed may acknowledge that there's going to be potentially more uncertainty, more volatility in markets, but also for the economy, since we don't know what policies may change or be implemented. And there's also the debt ceiling. And of course, there must be congressional action around that. And the debt ceiling itself, just the whole path to a point where there could be default, impacts the Fed's quantitative tightening. And so all these things, I think, are going to weigh on the Fed, and we'll see how much Chair Powell is comfortable with talking about the future before we get there.
Well, the debt ceiling is interesting because January 1, that's going to be a problem. Do you think because we are on track for this trifecta in Washington that's going to be dealt with swiftly?
Well, it's interesting. Even though we could have a mandate, a red mandate, it's not the case that all members of the GOP are all on the same page when it comes to the debt ceiling. Some will say, look, let's just raise it. Others will say, well, if we do that, we need concessions, we need spending cuts. And then there's some who may say, well, let's kind of go over the edge. There's probably very few who say that. Most people, I think, would understand that it would result in very bad outcome from the U.S. But still in all, you could have wrangling over the debt ceiling for months, and certainly that impacts how markets view the U.S. and whether or not we'll stick to our commitments. It also affects QT in the sense that the Treasury does have a wallet at the Fed, and they usually try to keep that wallet fat, $750 to $800 billion every day. But when the Treasury engages in extraordinary measures to kind of push off default on the debt ceiling, that reduces what's on the Fed's liability side of the balance sheet. So what does the Fed do with assets? Does the Fed slow QT? I'm not sure what happens there, but all in all, this could have major implications for financial markets, how the Fed conducts policy, and the economy.
Dana, it's going to be a very busy 4 years for all of us. We appreciate your time this morning. Thanks for being with us. Dana Peterson there at the conference board. With an update on stories elsewhere with your Bloomberg Brief, here's Danny Berger.
Hey, John. Vice President Kamala Harris gave a concession speech at Howard University yesterday afternoon. Harris said that she's proud of her campaign and stressed that, quote, when we lose an election, we accept the results. The vice president also pledged to help with a peaceful transition of power. President Joe Biden will address the nation at 11 a.m. this morning from the Rose Garden. German Chancellor Olaf Scholz has called for a snap election by the end of March, dismissing his finance minister, Christian Lindner. The decision cost Germany's three-party ruling alliance its parliamentary majority. Scholz accused Lindner of blocking solutions and misusing his trust. The conservative opposition alliance currently leads in opinion polls. Shares of ARM, those are falling in the early trade more than 6%. The chip designer issued a disappointing forecast for third quarter revenue. Investors placed big bets that ARM would be a major beneficiary from the massive spending on AI. But the company's designs and underlying tech are still used more heavily in other parts of the electronics industry, particularly smartphones, which leaves it vulnerable to demand swings. And that's your brief. John.
Hey, Danny, thank you. Up next on the program, policy priorities.
The country has spoken. We are a center-right country, and I think for Democrats to be able to compete in these sort of centrist, purplish states, they're going to have to field candidates who can appeal to them.
That conversation up next.
invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Stocks are up once again, up by 0.2% on the S&P 500. Bonds little changed after a big move higher in yields yesterday, 442 on 10s. Under surveillance this morning, policy priorities.
The country has spoken. We are a center-right country, and I think for Democrats to be able to compete in these sort of centrist, purplish states, they're going to have to field candidates who can appeal to them. You look at the rightward shift across the country, and maybe picking Shapiro would have helped marginally. The big issue, and we've been talking about this for months, is gas and groceries.
Here's the latest this morning. Republicans looking to complete the sweep and control the House, giving the party unilateral control in Washington, D.C. Speaker Mike Johnson telling Axios that the GOP is focused on kitchen table issues. I did events in so many cities, and it was the same concerns everywhere I went. It was the economy and the border, weakness on the world stage, and the rising crime rates. I think that's what motivated the voters. Joining us now is Republican Congressman French Hill of Arkansas. Congressman, thank you for joining us this morning. We appreciate your time as always, sir. I just want to begin with a simple question. How much confidence do you have that you can complete the clean sweep?
Well, Jonathan, good morning. It's good to be with you. I feel confident that we will have a House majority in control of the Republicans and that Mike Johnson can be reelected as Speaker of the House. We have a 220-seat majority now, just two more than the 218 that is required for control. And I think somewhere in the low 220s is where we'll end up in the next few days.
Well, with control, you may go from a congressman to a chair of financial services. What's that looking like right now, Congressman?
Well, the steering committee will meet after we elect our leadership and determine who should be the best candidate to serve in our committee structure. And after 4 decades in finance and 10 years in Congress, I am a candidate to serve as the chairman of the House Financial Services Committee. I'll be trying to make that case to each of the members of leadership in the steering committee over the coming days.
Well, let's talk about if this sweep does happen, the promises that potentially could become policy. The former president, now the future president, said promises made, promises kept. He said he wants to bring the corporate tax rate to 15% from 21%. He says he wants no tax on tips. He wants Social Security exemptions, $5,000 child tax credit, and also considering eliminating federal income taxes on first responders, members of the military, firefighters, etc. Can all of that get done, Congressman?
Look, I think the Congress faces a severe test this year. I'm glad President Trump was elected. I'm glad we have a Senate and House majority in place for the 119th Congress. But I really believe Congress will face a severe test in 2025. We cannot have a sustained 6 or 7% of GDP budget deficit year after year, and that's what CBO is forecasting following the avalanche of spending from the Biden administration. Secondly, we have, as you note, expiring tax cuts from the 2017 Tax Cuts and Jobs Act for President Trump. So Congress has the responsibility of trying to rein in that spending and increase the supply side incentives in the economy by making sure that we don't disincent investment, growth, career and job opportunities by penalizing change in the tax cut. To go lower or to give more tax benefits will all be in that mix that Congress will debate and try to build the best menu that produces economic growth from the supply side, combined with opening up supply side policies like energy advancement, all of the above, energy strategy and permitting across the country, reining in regulatory policies that constrain economic growth and supply by taking advantage of the Supreme Court's recent decisions to roll back the Chevron deference.
Congressman, I want to talk about reducing the deficit. What's the easiest path that you see Congress coalescing around to really offset some of the tax cuts and other measures that Donald Trump has said that he is going to implement?
Well, President Trump, during the last days of the campaign, said this was going to be a priority. I was pleased to hear that. He's talked to Howard Lutnick, his transition chairman, Elon Musk, his government efficiency point person, potentially for the new executive branch leadership. And those, they need to identify that. But they're going to find that this is hard to do when you have 2/3 of spending locked into these mandatory spending programs of the health care, Social Security, and benefit programs that are on a demographic trajectory. So I think it takes bipartisan leadership, both to reduce non-defense spending in certain categories, which will be a target of the administration, but you're not going to dramatically reduce that budget deficit till you get health care spending under control and engage in long-term reforms. And look, Lisa, my point of view is let's just show that trajectory lowering, that we're not projecting 6 or 7% annual budget deficits for the foreseeable future. That will send good market signals. That will get us back on the right track.
Congressman, just about 30 seconds here. Are you basically saying the idea of cutting $2 trillion from the budget is implausible?
I don't think it's implausible because of the $6 trillion in broad democratic priorities that Joe Biden imposed. He increased spending $6 trillion over his 4 years in office in new spending programs. Many of those are ripe for being pared back. I think you have to combine that with long-term mandatory spending reforms as well.
Congressman, this is the start of a much longer conversation, and we appreciate your time this morning, sir. Congratulations on the big win. Congressman French Hill there on the latest for the Republican Party and policy priorities.
Well, I'm just struck by this idea that, one, basically the Republicans think you can deregulate yourselves to growth. We need to see if that's possible. 2, it's not just Joe Biden who added to the deficit. Trump 1.0 also added to the deficit. 3, reminded of what Treasury Secretary Larry Summers told David Weston. The bond market may need to educate some lawmakers about what's going on, but I think French Hill's got it.
I'm not sure if 440 on a US 10-year gets that done. We'll see. Coming up on the program, Binky Chadha of Deutsche Bank, Tom Narayan of RBC, Andrew Hoddenhorst of Citi, and Bob Elliott of Unlimited. All of that in the third hour of Bloomberg Surveillance.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Our principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the parties. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
This was a resounding win for former President Trump.
The idea of good economics has turned into bad politics for the Democrats.
A lot of what we're going to do over the next few days is separating rhetoric from reality.
We now have a new investment regime.
This is the emergence of a new power structure in the United States.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
So following some massive gains in the equity market in yesterday's session, we add to them. On a Russell, yesterday up by almost 6%. This morning, up by another 0.5. On the S&P 500, an all-time high. This morning, we're higher by 0.2. On a NASDAQ 100, a record high. This morning, we're up by 0.3. And we're hardly discussing one thing. A Federal Reserve decision a little bit later on this afternoon. Apparently, they're going to cut interest rates by 25 basis points. Who cares? Apparently, they might do the same thing in December. Who cares? Because in 2025, the market's made a decision. The outlook is going to be very, very different to the one that Chairman Powell speaks to.
I'm sorry, I was sleeping as you were talking about this company or group that's going to be made. No, seriously, everyone's basically looking beyond the Federal Reserve because they're looking at this idea that right now they're going to say as little as possible. They're not going to telegraph how they're going to respond to any potential fiscal policy. That said, there are some questions they have to respond to. They have to respond to what the market is looking at. They have to respond to inflation expectations in forward-looking markets that are creeping higher. They have looked at those in the past. Why are they going to ignore them this time around?
We've still got to complete the puzzle, still got to find out if we actually get the sweep, the red sweep, and they secure the White House, the Senate, and the House. And once we get there, we can talk about policy with maybe just a little bit more clarity. Then we can talk about priorities and guardrails. Priorities. Last time around, Trump went with tax cuts first, then trade war second. What's the order of things this time around? Guardrails. Who's the new cinema in the Republican Senate for the Republicans? Who's the new mansion in a Republican Senate? Or is it the market that constrains the hopes and dreams that we saw on the campaign trail? Is it the market that constrains those hopes and dreams?
That's what Larry Summers seems to think so. There's going to be a bond market that needs to educate Washington, D.C. When it comes to the trajectory of policy, the TCJA tax cuts don't expire to the end of 2025. So it does look like this is an administration that could come in and based off conversations I've been having, it does seem like they're already starting to set up for what the, I don't know if they'd call it trade wars, but recalibration of free trade that they want to enact, that Trump has been basically on the campaign trail for. But that is why it makes, I think Stuart Kaiser killed it this morning, it makes this Fed meeting so irrelevant, and Jay Powell basically milked toast today in terms of what he's going to have to say in terms of all of these questions about 2025 and beyond.
So my first signal would be cabinet picks. Whoever he picks for Treasury. Is it Ambassador Lighthizer, or is it going to be someone who'd be quite market-friendly, as Scott Bessent say? Which one is it going to be?
Well, we don't know yet. That is, though, going to be the telltale sign to this market about how aggressive Trump wants to be and basically how antagonistic he wants to be towards China. If it is Ambassador Lighthizer, you could see the walls going up quickly and higher. We already know what Scott Bessent thinks about tariffs. He said they're a negotiating tool. 2.5%, 24 months. Xi Jinping, call us when it starts to bite.
Coming up this hour, a conversation with Binky Chowdhury at Deutsche Bank as the S&P 500 notches its 48th all-time high of the year. Tom Naran of RBC on Elon Musk's Tesla under a Trump presidency, and Andrew Honhorst of Citi looking for 25 basis point rate cuts. We begin this hour with investors embracing the Trump trade. Record highs on both the S&P 500 and NASDAQ following the biggest post-election day gain in market history. Binky Chowdhury at Deutsche Bank says the rally, quote, fits with the historical script of a rally after close elections once the result is clear. Looking a little further out, the market will have to grapple with the policy impacts on the positive side, tax relief, deregulation, and the negative side, tariffs. Binky joins us for more. Binky, good morning.
Good morning.
Are you saying yesterday's price action was more of a clearing event than pricing in policy?
So it's what we've been talking about for a while. As you go into, a very uncertain event, you tend to see, and you saw basically in a very big way across all asset classes, really, a massive blowout basically in what I would call the volatility premium. So implied volatility going a lot higher than actual realized volatility. And the event happened. It happened a little quicker than the market was sort of positioned for. And so what you see is basically those premiums collapse because the event has happened, the uncertainty is cleared up. And so if you look at yesterday's price action, equities, bonds, FX, and you overlay it with what happened in 2016, it's a pretty good fit. If you overlay it with the last few elections, it's right there. Maybe it's a little on the higher side, and you can get into the decimals of small caps did a little better, et cetera, but otherwise the pattern is really the same.
How are you and the team thinking about the sequencing of policy? Tariffs versus taxes, the good stuff versus the bad stuff?
Yeah, the way that we think about it is, first comes the business cycle and the economy, which I would argue is very, very solid. We like to look at what I call domestic demand. It's been running at 3% growth year on year, basically, for quite a while now. So it's pretty steady. So I would say it's pretty good. And so then you start thinking about overlaying policy on what is, a baseline view of policies weren't going to change. And you can make the case that, deregulation adds maybe another 0.5 percentage point to that. At the macro level, I mean, obviously, there's big differences basically in various segments, but and then you think about the tariffs, and there's great uncertainty about the magnitude and the timing, and that would take off. Perhaps, economist calculations are steady state calculations. This is not a topic that's about the steady state. It's all going to be really about the transition, but it's a benchmark way of thinking about it that, most calculations would tell you it takes off 0.5 point. So if I start with a baseline of 2.25, I'm back to 2.25, so there's positives and negatives. As you say, and point out, basically, it will all depend basically on sequencing. I would say difference now between now and then is the economy looks a lot stronger. So, you could, in principle, as a policymaker, take the risk of doing the negative before the positive, or even doing them together. But I would say the pressing issue is really the positive ones, and so my bias would be, and my hope would be, that they do those first. It also basically on the trade side, sort of pre-announces things or allows a lead time basically for, if this is a transaction, then for the transaction to take place.
There's a lot to unpack here, and I want to get a sense of just as you parse through some of these uncertainties, how much of what we're seeing already, you said a lot of it is just a relief rally. We heard the same thing from Stuart Kaiser. People were waiting for some sort of outcome, and now they're piling in because it has ended. Just in order to get a sense of whether this is something to buy into or whether to look for opportunities to sell, how much of this was just simply that relief rally and not having anything to do with the policies?
Yeah, so I think about it more like a bump in the road, so not really a relief rally. You're sort of hedging for a risk, and it's an event, and the event passes, and that basically gives you the upside or the reversal, basically, of that hedging action. I'm constructive, and I think, the rally basically goes further. I would say, the most important thing there is really the state of the economy and the business cycle, and is that going to really change? We have been very constructive on the cycle and basically remain very constructive on the cycle. And that's simply because, if you think about it, there's various aspects that happen in a cycle that just haven't kicked in yet. We're still talking about destocking, and when will restocking come? There's the funk in manufacturing. There's a long list of things that haven't happened yet.
Yeah, but then you overlay into this the idea of tax cuts, of less regulation, of mergers and acquisitions, and it's the reason why we saw from Julian Emanuel over at Evercore ISI an increase in his expectation for June of next year, 6,600. Are you looking at the same kind of upgrades to the forecast simply because there is this sense that we're turbocharging some of that growth and stability?
So I wouldn't disagree with that number. I think it's actually very reasonable. If you think about it, we've just put in 2 years of 20% plus upside on the S&P. So, yes, we are still constructive, but, the pace of move up will slow. But I'd say 15% is a very reasonable slowing from 22% 2 years in a row. Again, we've talked about this before. If you think about equities from a demand-supply point of view, positioning, as of, last Friday was 51st percentile. That's as close to neutral as you're going to get. We didn't see sort of the fear and the big pullback in positioning and a move to underweight, but, positioning's at neutral. If you go from the 51st percentile to the 100th percentile or the 99th percentile, which is where we were on July 16th, by the way, that's worth 7% on the S&P. That's not a small number. And in the meantime, if you look at other aspects of our demand-supply framework, I think one of the most surprising things is really, the very, very robust inflows that we've seen into equities. So while we were all voting and trying to watch TV, we had $5 billion in inflows into equities on the day. So, and I think, that's been a very important sort of driving force. So coming back to your question, is it going to continue? It's been continuing for a long time, so it will continue, I would argue. And if you think about it from a fundamental point of view, unemployment is pretty close to 4%, and GDP growth is running at 3%. So, and households accumulated too much cash at the time of the pandemic. So,
but to go back to the start of our conversation, you said potentially you hope President Trump does the bad things first, which would be the bad tariffs.
Good things first.
Oh, you want tax cuts first?
Yeah.
Well, the sequencing might be tariffs first, and if it is correct that he goes for tariffs first, having lived through Trump 1.0. Do you take him seriously or literally when it comes to what he's pitching on tariffs?
I take him both seriously and literally, yeah.
So you could start modeling in 10% tariff ring, 60% on China?
Yes, but that's not very easy to do. And that assumption, I could debate as to whether that's exactly the number you should use.
You've got to make some assumptions, though. You've got global in the title. What do you do with European stocks?
The issue with a lot of the calculations is simply that they're static calculations. So it's like I was trying to use, the economist word, which is the steady state. There's no such thing in the real world.
Right now, it's not about models. It feels like it's about feelings.
Yeah.
So what do you do with European equities for 2025? Do things get better better from here or worse? Can it get worse?
It's a pretty fluid situation. I would say there's more risk of upside than downside.
Interesting. Why?
Right.
Why do you think so?
So, I mean, you know, Europe basically hasn't really recovered because the pandemic was followed, you know, pretty closely by the Russia-Ukraine, the oil and the gas issue. And so, you know, if you look at any measure of activity in Europe, you know, we'll see that we had a big bounce coming out, basically. But we've sort of gone sideways for a couple of years now. So we've gone sideways, you know, that sort of suggests there is some resilience because not a whole lot of positive things have happened and we haven't started growing, but we've hung in there basically. And so, you know, I mean, if you think about, you know, we've had this conversation before about global manufacturing. I mean, it's in the funk, and Germany, for example, has greater exposure to manufacturing, so it kind of makes sense.
Yep.
And so, I'd say, you know, if you look at ISM manufacturing in the U.S., you look at German manufacturing PMIs. All PMIs and ISMs have their own quirks. You look at them relative to their own history, we're in the same place. So it's not really that much worse. So the call on U.S. equities has been working out for 2 years, and you know, yet we are in exactly the same place, and so I would argue there's more upside than downside risk. It's still maybe just a touch early, but I would watch the political developments in particular.
Yeah, could change things. Binky, thank you. Binky Chandler at Deutsche Bank. The political developments in Germany. Guy Johnson shooting me over an email this morning saying that maybe this is an inflection point for things to actually get better in Europe and not worse, which is kind of Binky's point. It's all relative to what's in the price right now. With an update on stories elsewhere this morning, let's get you the Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Moderna shares are rising 10.6% pre-market. The company reported third-quarter revenue that beat estimates, thanks in part to an early start to the sales of this season's COVID booster shots. Investors have been concerned about fading COVID vaccine sales and a slow launch of its RSV shot. Shares of Moderna, they are down nearly 50% through Wednesday's close. TSMC says Taiwan needs to invest more resources into advancing the country's chip technology and expanding its supply chain expertise. A senior vice president spoke just hours after President-elect Donald Trump clinched the presidency for the second time. Trump had said Taiwan took semiconductor business and jobs from the U.S., and he plans on leveraging tariffs to convince companies like TSMC to build plants in the U.S. Ray Gunn has hung up her dancing shoes. Breakdancer Rachel Gunn told a radio station that she is retiring from competitive breakdancing due to the scrutiny of her performance at the Paris Olympics. The 37-year-old went viral after she failed to get on the scoreboard in the 3 of her competition rounds and showcased unusual moves like the kangaroo hop. She said while she initially planned to continue competing, her experience at the Olympics was so upsetting that she changed her mind. That's your brief, John.
Danny, thank you. I'm not going to pile on Ray Gunn. It's one of the highlights of the Olympics for me. It's one of the best parts of the French Olympics this year.
I will just say, a lot of Olympics is sort of out of my aspiration. That wasn't, and it was wonderful.
You felt like you could take part?
I actually did take part with the children. We all did it, and it was actually really fun.
You could take her place.
Let's not go that
For
far.
Australia. Up next on a programme, the Morning Calls. I'm sure they'll make that happen for you. Plus, Tom Narayan of RBC as Tesla surges on the back of Donald Trump's win. That conversation's next. The bar is low, right?
I know.
I promised I wouldn't pile on. Stop
you did.
it.
You piled
Stop
on.
it. This is Bloomberg.
spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg.
Equities up by 0.25% on the S&P 500. Let's get you some morning calls. First up, Baird downgrading JP Morgan to underperform. A rare sell for the big bank. The analyst David George seeing limited upside and poor risk reward. The stock is down 0.6% after rallying more than 10 in yesterday's session. 10% higher. 11. Did we get close to 12? I think we did. Ridiculous rally.
After an incredible rally already.
Next up, Cantor Fitzgerald cutting its price target on Qualcomm to 160. The analyst noting better than feared guidance despite worries of weak Android handset trends and declining Apple manufacturing plans. That stock is up by 6.4%. And finally, Bank of America raising its price target on Tesla to 350, saying it will likely benefit from any federal regulation of autonomous vehicles, adding the relationship between Elon Musk and Donald Trump will need to be monitored closely. That's like Southside language. That's how you avoid talking about it, right?
But how do you put a price target on a relationship, which is essentially what people are having to do?
Sticking with Tesla, shares soaring on the back of Trump's presidential victory. GM and Ford also getting a boost. Tom Naran of RBC writing, we find the positive moves from U.S. auto names puzzling, especially considering how they reacted to tariff threats during the first Trump administration back in 18 and 19. Most puzzling to us is the positive reaction to Tesla shares. Tom's with us around the table. Tom, good morning.
Good morning.
What puzzled you about Tesla? What didn't make sense?
Well, it's just we don't have evidence that we're going to get national federal deregulation of AI. Tariffs is not a good thing for Tesla. And any repeal or attempted repeal of the IRA would really be bad for Tesla. So other than the fact that the CEO has a relationship with the president-elect, I don't really see why it would benefit shares of Tesla.
Do you have any confidence that he could stop those bad things from happening to the company?
I mean, we saw the first go around, 2018, 2019. I mean, it was more of a threat, so it didn't really happen. So that could be a silver lining. Like, is this just a bluff? I don't know. I don't know what's inside the hearts of these individuals.
Well, I mean, what about dark MAGA, don't you understand? I mean, I guess this is sort of the question that we were just hearing about, which is like, how do you put some sort of price tag on a relationship that seems incredibly interconnected and where there is one person who clearly has an ear into Donald Trump?
Okay, so here's where I would probably agree is, remember, like, autonomy is like 70% of my Tesla valuation, right? Yep. Robotaxi, FSD. If there is federal deregulation, that would be tremendous for Tesla. Not just Tesla, a lot of companies doing autonomy. So if that happens, sure, we just don't have evidence of it. The only commentary we've heard has been in Trump rallies to saying the opposite.
But Tom, we have a little bit of evidence, right? Trump 1.0, Tim Cook was dealing with some issues with Apple, called the president kind of, I think, leaning on his ego a little bit, and then said, can I come in and talk to you about it? And then Trump had a much better relationship with Tim Cook. Couldn't Elon Musk maybe get carve-outs for tariffs, but then also get deregulation on the back end? Because of his relationship and given how Trump likes to run his White House, he's in a prime position.
Well, the optics of how do you single out one automaker versus another,
Biden administration did it. They had GM over and didn't have Tesla when they had this whole EV announcement.
Yeah, but that was more of optics, right? Because of the UAW situation. That wasn't an actual policy. I think it'd be very difficult to give preferential treatment to one OEM and not the others. We saw clean tech get destroyed. Shares of clean tech stocks got destroyed. The same beneficiaries as Tesla, energy storage, EV credits, et cetera, making batteries. How do you benefit one company and not the others? The only way I see it is if it's a rising tide lifts all boats. If he was able to convince President-elect to change policy altogether, but I don't see that's what's happening.
Although we did see shares gain in Ford and GM. You said it was a little bit confusing, and it was even more confusing to see Tesla shares rising as much as they did. There is a larger question about de-emphasizing some of the shift in terms of composition of autos that they make, and that could potentially really benefit their business models, especially if the transition has been sort of forced upon them a little bit too quickly. Do you buy that? Do you think that enough could justify some of the rally?
I don't think so. I think if you look at the investment, GM is actually the biggest battery maker in the U.S., right? More than Tesla. And Ford's talked openly about how, look, if they were to change their pivot the situation now away from BEVs, what if the next administration comes in and is more restrictive and it makes you sell EVs more? Like they've already gone down this path. And again, all you have to do is look at what happened in 2018, 2019. Threats of tariffs were problematic, not just to the OEMs, but the supplier base. They're very broad based on their exposures. And also, like, I understand the competitive argument, right? Like, fine, maybe there's less Mercedes or BMWs, but the person buying a Chevy Silverado pickup truck, it's not like, and he's going to be like, well, I was going to get an E-Class, but now I'm going to get a Silverado. They don't really compete against each other, you know.
I'd rather have the Silverado anyway, for what it's worth. For what it's worth. I got a message a moment ago, as you were talking, about autonomous driving. And this individual, Bloomberg subscriber, said, regulation isn't the problem with full self-driving, it's getting it to work. What is the biggest problem, regulation or getting it to work? And do you need looser regulation to achieve the other?
Well, there's a difference between full self-driving and then robotaxi. On FSD, regulation is important, I would argue, to incent people to purchase the product, right? Everyone thinks they're a good driver. It's hard to sell safety, but if it's mandated like airbags and seatbelts, right, saves lives, that I think would be important to push it over, absolutely. But that's like a state-by-state issue. I mean, a federal law to mandate a level 2+, I don't know if I see that happening with a new administration.
We were trading vibes yesterday. We'll start to trade policy pretty soon. I hope, when we find out what those policies are and whether those campaign promises become reality over the next 12 months.
Trading vibes is so fun. I mean, actually, the funny thing about trading vibes is how much of the rally is just people having vibes that, thank goodness, I don't have to speculate about whether we're going to have a result to the election.
I go back to one consistent theme in the last 24 hours in financial markets. We're trading a positive growth shock in America, and basically anything exposed to that, with the exception of some consumer-facing companies with very thin margins who are dependent on importing things from China, and I'm thinking of some retailers in yesterday's session.
Which is the reason why a lot of the good news is getting priced in. The key question is, how do you value that? How do you understand what that looks like? And when maybe it's getting over its skis.
Tom, it's good to see you. It's good to catch up. We'll do it again soon. Big, big future. This industry, what's it going to look like? Auto manufacturing could get shaken up big time all over again. Up next on the program, jobless claims. We'll catch up with Andrew Holmhorst of Citi, Bob Elliott of Unlimited here as well, looking ahead to a Federal Reserve decision this afternoon.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Seconds away from some economic data, 60 minutes away from the opening bell. Equity futures on the S&P 500, positive once again, up by 0.25% on the S&P. On the Nasdaq 100, up by 0.4%. Both the S&P and the Nasdaq coming into Thursday at all-time highs. The next data point, and we haven't discussed it at all, it's jobless claims. Jobless claims. The previous number was 216. The estimate this morning is for 222 with the economic data. Let's cross over to Mike McKee. Good morning, Mike.
Good morning, guys. Well, we're waiting for the jobless claims numbers to drop, but I can give you productivity and unit labor costs. Productivity up 2.2%, a little bit lower than anticipated. 2.5 was the forecast. Unit labor costs rise a lot more than anticipated, about double, 1.9% from 1%. So there's a question for the Fed going forward is, do we see some pressure on the labor cost side in terms of bringing down inflation? Now jobless claims, 221 is the number for last week. And at this point, it doesn't look like a significant move, but we're going to have to wait and look for sure. The prior week revised up to 218,000. Continuing claims, 1,892,000. That's up by 39,000 from a week before. So at this point, we have a little more in the way of jobless claims, but probably mostly noise. And we have somewhat surprisingly lower than anticipated productivity number. So we'll see how the Fed talks about that if they do this afternoon.
Well, I can tell you how the bond market's responding, Mike. And Mike, thank you, sir. Yields are a little bit lower. We're down a basis point on 10s and down 2 on 2s. Though I have to stress it's kind of meaningless in the grand context of like the week so far, given the fact that yesterday yields were higher by double digits pretty much across the whole curve. Andrew Holmhorst of Citi is alongside us now for more. Andrew, good morning to you. Let's start with jobless claims, and then we can get to all the rest of it. Claims are really, really low. And you've been looking for a much weaker labour market into year-end. Why doesn't that back up that theory?
It's a strange labour market. It's a different labour market than something that we've ever seen before, where we have really low hiring rates. We see the JOLTS data. We see the percentage of people who are getting hired into new jobs. And that number is low, so it is hard to get hired into a job. That's the bad news. The good news is what we're seeing in jobless claims, in the initial claims at least, that is showing us that the layoff rate is still low. So we have a strange labor market where it seems like people are hanging on to the workers that they have, but they're not necessarily wanting to hire more workers.
So you think 25 today, and you think 50 in December, and everyone else is thinking about 2025 and the prospect of rate hikes and not rate cuts. How useful is the price action of the last 24 hours to project out what 2025 might bring?
Yeah, I think not useful at all. I really don't think that you're supposed to take a macro narrative away or a Fed narrative away from what's going on in interest rate markets right now. If you look at what's happening in the macro fundamentals, we do have a softening of the labor market. I think that's clear after the last jobs report, where even after you adjust that jobs report for hurricanes and for strikes, and I think that's part of why the market can't react to it. We also had the election coming up at the time. But with all that distortion, it's hard to see. But if you draw a through line through it, what you see is the pace of job growth is slowing. You see the unemployment rate has risen from its lows, and it looks like, if anything, it's still trending higher. And that's going to make the Fed think there's some downside risk to employment. And then you move to the inflation side. We just got numbers for the third quarter, 2.16%. Quarterly annualized core PCE inflation. That's essentially at target inflation. So if you're the Fed, you're looking at inflation that's close to target, you're looking at an unemployment rate that's still low but maybe rising. The path is going to be towards lower rates. So I really don't understand the move in the market or the new narrative that this is a Fed that might need to hike. No, this is a Fed that's cutting.
I think a lot of people would agree that this Fed probably isn't going to hike, although there was this one person out there who did put out the prospect of potential rate hikes, a number of people actually. There is a feeling, though, that they can't cut nearly as much, especially at a time where the deficit's probably going to expand, and at a time where, even if it's not accelerating, this is an economy that's pretty solid. How do you push back against that?
Well, first of all, I'm not sure that it's an economy that's pretty solid. I know that we're seeing GDP growth that's running close to 3%. On the activity numbers, those look fine. Again, if you look at the labor market, it doesn't look as strong. And I think we just had a referendum in this country in some ways on the state of the economy, and the results were not positive for how people are experiencing this economy. And you see that in some of the survey data. You ask people, are jobs plentiful, are jobs hard to get? You see that hard to get number that's been coming up. You see a hard to get jobs number that's elevated right now. If you're the Fed, the mandate is employment and the mandate is inflation. Inflation that's close to target, you have a labor market that's softening. And remember, back in August, Chair Powell said, we would not seek or welcome any further softening of the labor market. That means you need to get policy rates down towards neutral.
But this really highlights how messy the data is and how we can't really understand it, because at the same time that you're saying that the election was a referendum of sorts and that we've seen this in sentiment, at the same time we're seeing the U.S. City Surprise Economic Index rise to the highest level going back to April. At the same time, ISM Services, the employment component, actually increased more than expected. So how much are you looking at, say, the rising inflation expectations as data to pay attention to or not pay attention to for the Federal Reserve?
No, I think it's a fair point, and I think the signal-to-noise ratio in the data is just lower than it used to be. And in some ways, we know why that's happening. If you look at the jobs report, the payrolls report, for instance, the response rate is much lower than it used to be. And that just means that that data is going to be noisier. And we see that in some of the revisions. We've had just consistent downward revisions to those jobs figures. So we get a jobs figure. You look at the City Economic Surprise Index as a positive surprise. The market reacts to that. Well, then I'm not sure if people are paying as much attention when a month later, 2 months later, sometimes a year later, right, with those preliminary benchmark revisions to the payrolls numbers that turned out to be 818,000 lower in terms of the level of jobs than we thought it was. Those revisions have been to the downside, and that means we're actually looking at a weaker labor market than we thought, but the market's already reacted. The narrative has already shifted. So what we're trying to do is look at the data as best we can, draw those through lines in terms of where things are headed. Yes, I would agree. Right now we're running good GDP growth. We have an unemployment rate that's low 4%. That's not a bad thing either, not a bad place to be. But the question is, where are we going from here?
I want to pick up your point about a referendum. Was that because of jobs or price pressure and inflation?
I think it's a combination of the two, right? And that's why there is this idea that you're supposed to be, maybe adding the unemployment rate to the inflation rate. But when you look at the consumer sentiment surveys, for instance, you're absolutely right. People are saying prices are high. That's one of the reasons that they're unhappy with where the economy is. The other thing that I think matters, and maybe we don't pick it up as well in some of the survey data, is look where interest rates are. And it goes back to the discussion that we were having with Lisa, that with fiscal concerns, it means that longer-term interest rates have risen again. It means mortgage rates are going to be close to their highs again, right? We thought they were going lower because the Fed was cutting interest rates. Now they're higher again. Those are actually reasons that the Fed might end up being more dovish. I understand it's a complicated scenario when you have loose fiscal policy that's raising interest rates.
Andrew, can I jump in?
Yeah,
Don't you think that 50 basis point cut contributed to higher long-end yields? Because before we're even talking about a Trump presidency or a Trump sweep in a material way, ever since they cut interest rates, yields bottomed within 24 hours of that period. They've been up by 60, 70. I haven't tallied it since, but we're at 360 last time around. So let's call it 80. About an 80 basis point move on a 10-year. Don't you think the Fed easing has had something to do with that?
Well, all else equal, if the Fed is more dovish, you're going to get a steeper yield curve. The level of short-term interest rates is going to be lower relative to the level of long-term interest rates. If you have a more dovish Fed, then you should be more concerned about medium-term risks to inflation, about upside risk to growth in the longer run, and that's where you're going to have higher yields further out the curve. I think what happened here, though, was we were coming into that FOMC meeting, the data looked pretty bad, right? We had that jobs report that looked pretty scary, the unemployment rate accelerating, and so the Fed cut 50 basis points, and I think they were thinking maybe they should have cut 25 basis points at the previous meeting, so kind of roll those together and you cut 50. The move that we've had higher in yields, I would really go back to what Lisa was saying. We've had these consistent upside surprises in the data, and yields just track that higher. The election, I think, also playing into that move higher that you have in yields. But the longer discussion around that, I think, is where is monetary policy going to be relative to fiscal policy? We still have large deficits, and that is going to mean that longer-term yields are higher.
So my opinion on this doesn't matter, but I have to respect the price action of the last 24 hours. There are going to be service workers in Nevada that don't have to pay taxes on tips anymore. We're a few house seats away from this reality. We're going to have corporate tax rates coming down from 21 to 15 with conditions I know. These are big changes for the US economy, which should stimulate demand. You're already seeing that kind of confidence level being baked into bank stocks. That's the market screaming. And later on this afternoon, we're going to have a Federal Reserve with an easing bias talking about an economy in the way that you do. I just feel like we're on two completely different planets right now. Financial markets are going to be right over here, and Chairman Powell's going to be right over there. For how long? When they put out projections for December, how much weight as a market participant can I put on their dot plot? He's going to be doing a news conference today based on a dot plot from September 18th. Andrew, this Federal Reserve news conference today is absolutely ridiculous. And I just wonder how different the conversation is behind closed doors. Yeah. Can we at least acknowledge that the conversation we hear in the news conference today is going to be radically different to the conversation behind closed doors? These guys have got to consider now a very, very real different scenario for 2025 than they had to a few months ago.
Yeah, I think that's guaranteed. I think that there will be a very interesting discussion that's going on at this FOMC meeting, and we'll see that in a number of years in the transcript. And what we're going to hear today in the press conference is going to be as little guidance as possible, right? Because they don't know. And really, we don't know in general because we didn't have a very robust policy discussion going into this election, right? We talked a lot about politics, not a lot about policy.
But you know that they're in the risk management business. So if I'm in the risk management business and I face two very different scenarios in 2025, which are the polar opposite of each other, your world, recession and higher unemployment, and Donald Trump's objectives, lower unemployment and a domestic boom. If you're in the risk management business, why are you cutting 50 in December?
I come back to inflation, right? Because that's the other mandate. That's the other thing that I worry about. Is this potential stronger growth outcome in the economy going to drive inflation? Everything we're seeing is going in the opposite direction, right? We have demand that is running below supply now. We have goods inflation that's come down. We have housing inflation. I mean, again, we're talking about mortgage rates that are back up towards their highs. We have the housing sector that's in contraction. So that's why the Fed is in a very different position than the market here, because the Fed is looking at this and saying, inflation looks under control. That's what they're saying behind closed doors. They're not going to say that today in the press conference. Inflation looks under control. And I have this risk, downside risk to the employment mandate. Now, if I'm wrong and we get stronger job growth and stronger GDP growth, that's great. But I'm not going to be wrong in cutting rates now. And that's what they're going to cut today.
It's going to be a very interesting few months ahead of us. Andrew, appreciate your time. It's always good to see you, buddy. Thank you, sir. Andrew Honhorst there of Citi. If you are just joining us, welcome to the program. Equity futures here on the S&P 500 higher by about 0.1%. So the market's got a little bit of a lift. You see that on the NASDAQ 100 as well. We're higher by 0.4%. On the Russell, after a monster rally yesterday of almost 6%, we come back down by about 0.4%. If you can turn to the bond market, we've seen this huge move, not just in the last 24 hours, but ever since the Federal Reserve cut interest rates back on September 18th. That morning, the 10-year was trading in the 460s. This morning, we're trading in the 440s. This bond market picture, Lisa, is radically different to the one that they looked at the last meeting.
Which raises the question how they're going to address this. And interesting to Andrew Honhorst's point is that this actually increases the downside risk for them if financial conditions are tighter, and that puts an even greater constraint on mortgage rates and other longer-term rates. His point, though, about behind closed doors, how there will be a very interesting discussion about the response mechanism and scenario analysis. Can't wait to read that in 5 years.
Can't wait to read that in 5 years, and can't wait to see the changes that we might get in about 6 months' time. Bob Elliott of Unlimited joins us now for more. Bob, good to see you.
Good to see you.
How much changed this week for the global economy?
Well, I think we've basically doubled down on the pursuit of overly easy monetary fiscal policy in the U.S., and that's a big deal ahead. particularly because the consequences of the overly easy fiscal policy are probably not going to be meaningfully felt in time for the Fed to arrest their planned 100 or 150 basis point cuts, given the timing. And the Fed can't really act on prospective fiscal policy until it actually happens, and that won't happen until later in 25.
If it doesn't shape direction, will it shape pace? We just had a conversation about maybe going 50 in December. If you're the Federal Reserve and you face the very real risk of things turning the other way, do you have to slow down that pursuit of neutral?
I think they're going to be looking. The Fed's backward looking, and they have to be backward looking because they have been so poor at trying to predict what's likely to transpire, and have learned their lesson as a result. So they're going to be looking at the actual data, combined with the fact that they strongly believe that inflation is over, and so the cuts will come. Is it 50 or 25 in any particular meeting? It doesn't really matter that much, particularly for the equity market or growth. The direction of travel is clear. Rates are going down, even if inflation continues to be elevated relative to the mandate, even if growth continues to be pretty good. They're cutting rates because they believe that inflation is dead.
So do you buy into that notion, or do you go the opposite direction and say inflation is alive and well, and these are the ways that I want to play it?
Yeah, well, I think if you look at the actual data, right, core PCE is 2.7%. That is above the Fed's mandate. The Fed is unlikely to actually meet its SEP goals for December as a function of that. We continue to have a relatively tight labor market, maybe not quite as tight as it was before, but still tight. We're seeing those unit labor costs rise. In the data that we saw this morning. All of that points to elevated inflation pressures ahead. If the Fed is going to continue to pursue this over-easy monetary policy, the solution's pretty clear, which is you want to buy equities and you want to buy gold and you want to sell bonds.
And so at this point, I guess this is what we're trying to parse through. How much is the course of the economy from before, what people are currently looking, and basically a sigh of relief? We know what happened with the election. Regardless of the outcome, we know we have an outcome, we can move on, versus that there is actually going to be a growth shock from the new policy. How much is that growth shock already being priced in?
Yeah, I mean, what's priced in, if you just look at the post-election indications, are essentially, the equivalent of a upside growth data point, like a non-farm payrolls that was better than expectations. So incrementally expecting to see stronger growth, but there's a long way to go in terms of the pricing of a stronger growth environment with easier fiscal and easier monetary policy ahead.
Bob, there's also a lot of inflation potentially to be priced in next year. Tariffs coming potentially almost immediately. On top of that, you talked about a tight labor market. It can get even tighter if we have stronger immigration rules. And the former president talked about deporting people. How does December mean the Fed can cut if that's on their doorstep in January?
Well, the Fed doesn't know what actual policy will be when the Trump administration comes in. And the reality is most of us don't know either. And so that ambiguity of what they're actually going to do, separating campaign rhetoric from actual implemented policy.
Directionally, we know, though, don't we? And isn't that enough?
It's not particularly clear how fast, if you get, a 2.5% tariff raise on China every 3 months for the next 4 years, that's going to be a radically different impact on the macroeconomy than if we go to 60% on day one of the Trump administration. It's important to recognize we don't really know what's going on. We don't know campaign rhetoric to policy.
But isn't that also almost the Fed's answer? We don't know, so we have to sit this one out?
Well, they don't know, so they're looking at the macroeconomic data that they believe is going on. They believe inflation is dead. And Chairman Powell in September rewrote the reaction function. The important thing that happened in September was he said not just that inflation is dead, he also said the economy is strong, and even with that, I'm comfortable cutting ahead and putting that 3.4% dot on 2025 in the SEP. He was comfortable with delivering easier monetary policy in a strong growth environment. And so when you see that, the real question of the Fed meeting today is, does he call into question any of that when he stands there in the press conference, at least even raising the possibility that maybe it's imprudent to be cutting given how strong the economy is and how inflation isn't meeting what their targets are? My guess is he'll reaffirm this over easy and accommodative monetary policy, and that means this broad over easy policy that we're seeing in the US and globally is going to be driving asset markets ahead.
So what's your one question for this afternoon, if you are actually going to still watch, even though you kind of think you have a sense of what the outcome is going to be? And by the way, we're hosting a special, so we'll be watching.
I'll be watching.
Thank you. Good.
I appreciate it. No question about that.
Thank you.
I always
viewer at a
tune in.
time.
You know, my biggest question is going to be, what level of inflation data and what level of growth data would cause you to change your mind about the direction of travel of interest rates? And that, I think, would be, you probably won't answer that question, and it probably won't be asked because it would be a bit rude to do so. But if I was sitting in the room, that'd be the question I'd ask. And the answer would be very telling, assuming it's honest, that about what the direction of travel will be in response to the data that we're seeing.
Bob, I'm totally with you. The higher risk that things break the other way, is that sufficient to disrupt the easing bias? I think that's the number one thing for the Federal Reserve into year end. Bob, it's good to see you.
Good to see you.
Thanks for catching up with us. Bob Elliott there of Unlimited with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Recapping the economic data we just got a few moments ago. Jobless claims ticking up in the last week. Initial claims increased by 3,000 to 221,000 in the week ending November 2nd. That is roughly in line with estimates, and it was the first increase after 3 weeks of declines. Lyft shares, those are surging pre-market nearly 23%. The ride-hailing company reported third quarter results that beat Wall Street estimates. Its fourth quarter forecast also topped expectations. Lyft also announced that it plans to work with autonomous vehicle companies like Mobileye, May Mobility, and Nexar. Now, according to Bloomberg calculations, the mystery French trader known as the Trump whale is set to rake in a $48 million profit as a result of the election. He bet that Trump would win the presidency, the popular vote, and the swing states of Pennsylvania, Michigan, and Wisconsin. And speaking with the Wall Street Journal, the trader was critical of the pre-election polls, saying that he viewed them as biased towards the Democrats. And that's your brief, John.
Danny, thanks for that. And I suggest you read that. It's a fantastic piece in the Journal this morning. His criticism was that people weren't going to tell the truth. And the more interesting polling for him was to ask them, who do you think your neighbor is voting for? Which should reveal or could reveal who that actual person was more inclined to vote for, and they were the polls he was following.
This just shows how A, polling has changed, and B, that we all are a little bit envious that he had the payday that he did, even though we all mocked him for skewing
I'm
results.
sure he's grateful too, because his family didn't know, right?
No,
and wasn't this his whole net worth?
Basically, 30 million of his liquid assets.
Oh, my goodness, I'm pleased that worked out. Up next on the program, setting you up for the day ahead. You're watching Bloomberg TV.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
countdown to the market open as we bring you the first trades across Europe.
We'll debate throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Let's give you a sneak peek of the calendar. Let's go straight to the trading diary. So a look at what you can look for through the next week or so. Later on this morning, 11 a.m. Eastern Time, you'll hear from President Biden. Then we'll get a Fed rate decision at 2 p.m., followed by a Chairman Powell news conference 30 minutes later. Friday, UMich sentiment. Tuesday, Home Depot earnings. Wednesday, CPI. Thursday, PPI. Another round of jobless claims, plus more results from Disney. Looking ahead to this afternoon, Mike McKee joins us for more. Mike McKee will be in the room with Chairman Powell. Give us an idea of what you'll be pushing for from the Fed chair.
Everybody on Wall Street wants to know what they're going to do now that Donald Trump has been elected, because there's been a sea change in the economic outlook. But as you were talking about with Andrew and Bob in the last segment, it's probably not going to come. He's going to dodge the question because he doesn't know yet. There's no point in getting involved in any kind of argument with the president-elect at this point. They'll just wait and see, which should make the afternoon relatively boring. I think what we might look for is an assessment of the economy and whether that has significantly changed since September when they put out the last SEP and dot plot. They're not going to give us a new one this time, but do we get a feeling that they might see things a little differently?
Mike, when was the last time that there was a Fed rate decision that actually had consequence so soon after an election?
Oh, we've had that happen a couple of times. I think one of the biggest ones was when we saw Alan Greenspan and the Fed lower rates after the election that Bill Clinton became president and George H.W. Bush lost. George Bush blamed Alan Greenspan for not lowering rates sooner to get the economy going. And that was at a time when people did criticize the Fed a little bit more than they have now.
Mike McKee, looking forward to the coverage a little bit later. Mike McKee on the Federal Reserve. That news conference taking place at 2:30 Eastern. We'll have some special coverage for you at 1:30 Eastern Time. A Bloomberg Surveillance Special, The Fed Decides, joined by Bob Michael of JP Morgan, Aditya Bave of Bank of America, the former Fed Vice Chair, Richard Clarida, and we'll catch up with Matt Lazzetti of Deutsche Bank as well. The list is a whole lot longer than that. I think Reader of BlackRock is on that as well. So looking forward to all of that this afternoon. Coming up tomorrow, we'll catch up with Peter Chi of Academy, Adam Posen of the Peterson Institute, the former Kansas City Fed President Esther George, and Subhadra Rajappa of SocGen. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
It'll be easy, but at least there's a theory of change.
In case you missed it on Bloomberg Technology.
We're excited to really change the expectations for space companies where you have this always-on, reliable, and frankly dynamic satellite connectivity that you would expect of your power grid or of your cell phones. And so we think that this is a huge opportunity space, and our first contribution to it is through shared infrastructure.
You can see this whole ecosystem developing, and you have an exponential growth right now because easier access to space means more demand for space, and that's the definition of an exponential growth function. So if you think about someone like Varda, who is only possible now because access to space is cheaper and easier, we're demanding more access to space.
I think that's what's so exciting from a business perspective, is the fact that if you can do it, you're one of the few numbers of organizations in the history that have actually pulled it off. And so it creates a very defensible position, because again, space is very, very hard.
Don't miss Bloomberg Technology live every weekday.
Day two of a Trump-driven equity rally. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Bassett. Katie Greifeld is on assignment today, and Bloomberg Open Interest starts right now.
Coming up, Jerome Powell faces a tough test in the new Trump era. The Fed is set to cut rates later today. As Trump's win continues to ripple across markets, we'll get the outlook from Mark Bristow, the CEO of gold giant Barrick, plus a check on chips, I should say. Qualcomm jumps on a bullish sales forecast, while ARM drops on a more tepid outlook. Let's take a look at where markets are trading right now. In terms of futures, we continue to see gains. Okay, they're not huge, right? But we're up 0.25% on the S&P, and NASDAQ futures are up a little bit bigger. 10-year yield coming down. This is essentially a dead cat bounce because we did so much yesterday. We're letting off a little bit of steam today. You can see the yields are still about 440. The gold price is coming up 1%, and at 26.84, it's not that far off of its all-time highs. Bitcoin isn't that far off of its all-time highs either. Coming down 1 2/3%, but still almost $75,000. I remember when I first started covering Bitcoin, and I could have bought one for $75.
Just incredible. Was that 4 decades ago?
No. One decade.
We know you love to talk about your age. Anyway, some movers to watch here. Qualcomm surging today as it sees strength in the Chinese smartphone market recovery. We're going to talk about Qualcomm more in this show here because, of course, it is one of those stocks that Bloomberg has previously reported was considering M&A, potentially even when it comes to Intel. We will get there later in the show and talk about those details. ARM, on the other hand, maintained its annual outlook, but warned for a slow smartphone recovery that could overshadow AI progress. Also, keeping an eye on Lyft moving higher after reporting record trips for the quarter and seeing progress in its commuter program. And next hour, we do speak with the CEO of Lyft, Matt.
Yeah, absolutely looking forward to that conversation with Ed Ludlow. I just want to point out, that the Fed meeting has been kind of overshadowed by this Trump win, but we're still going to focus in on what to expect. This chart looks at what the market is pricing in for next year. Right today, they're very likely to just continue the status quo and cut 25 basis points. But next year, it is shocking to see how much has come out of market pricing. We were looking for 170 basis points of cuts, and now the market is only pricing in, Sonali, 75 basis points of cuts next year.
And it's interesting to see what this is all meant for the push-pull between short-term and longer-term interest rates. We didn't hit the 4.5% level yesterday. That was the critical mark.
On the 10-year yield.
On the 10-year yield. That was a mark that a lot of traders were watching for. And given that not only did we not hit that mark, we've also seen some of a give back. I think that really shows that there's a little bit of uncertainty here still.
I mean, you had a huge run-up in rallies yesterday, and today we're giving off a little bit, right? That's
just a little bit.
That's what I would call a dead cat bounce.
What I'm watching still is that House race, which is still outstanding and will matter for tax policy. Maybe not tariffs, as you've pointed out before, but definitely for taxes moving forward.
100%. I mean, that is really the keystone here to a government that's allowed free reign in 2025. Let's bring in Nadia Lovell. She is Senior U.S. Equity Strategist at UBS Global Wealth Management. Nadia, first of all, great to have you here on set. Thanks for joining us in person at 731 Lex. We saw yesterday essentially a replay of what we saw in 2016. So can you look at 2016's playbook and just chart a course forward for 2024?
Yeah, you know, we normally get a rally after election, so that's nothing new. And we had expected that you would see a bit of a rally in the market if Trump did win. And so yesterday wasn't too surprising to us to see financials or small cap outperform, but what was surprising was the magnitude. I mean, remember, after the win in 2016, day one, the market was up a little over 1%. Yesterday, we got more than double that, right? So that was surprising. But I think also what's happening in the market is that the fundamentals in the market itself remains pretty solid. You know, you're entering a period of seasonality. You're also having buybacks come into the market. And let's not forget, the economy is actually doing really well, right? And earnings as well. And so not surprised to see the market continue this momentum into the year end.
Today, the 10-year, to Matt's point, did not give back that much of the loss yesterday. You're just under 440 still. With the expectation that interest rates could be higher than expected, at what point do you have to worry that that spills over into the stock market?
I think that's a great question. It's something that we're all watching. But remember, it's not so much a level of rates that matters for equity, is why a rate's higher and the velocity of that move. And so we've seen, you know, the 10-year move up about 80 basis points off of the September low. And so we're watching, like, do we get closer to 5%? I think that then you start to see some impact to equities. You are seeing already some impact to the interest rate sensitive areas of the market. I mean, utilities, real estate as well. You're seeing a bit of a pullback there. But if the movement in rates is growth driven, we talked about stronger economic growth, then equity markets can absorb that. We've seen it, multiple record highs.
You know, Matt, it was interesting. Jay Hatfield yesterday said his 6,600 assumption for the S&P next year was contingent on 3.5% 10-year.
Yeah, absolutely. I mean, he thinks that rates are going to come back down again. I think he's looking at less of an inflation bump than a lot of other people are expecting. Who knows what's going to happen if or when Trump puts tariffs in place. We do see, Nadia, as I pointed out at the top, markets pricing in far fewer cuts from the Fed for next year. I think the chart is 291 if you want to pull it up on your Bloomberg at home. Only 75 basis points. You know, we were looking at 170. That's a dramatic repricing of expectations.
Absolutely. I mean, we are all looking for 25 basis points cut today, and we think we'll get another 25 in December. And next year, we're still at 100 basis points cut, less than what the market is pricing in. But, you know, we do think that, yes, Powell has said most of the time, Fed isn't political, but the Fed is data dependent. And so a lot of this is going to depend on the data on the new administration. We have to recognize that fiscal policy as well as trade policy and immigration can have an impact on inflation as well as economic growth. And so if those two things start to accelerate, it could make the work for the Fed a little bit more challenging in 2025. But at the same time, you have to consider that if we get a bump up in inflation from tariffs and a push down on growth, the Fed is probably not wanting to have interest rate too high because they're going to be concerned about the growth picture.
What is the most underpriced risk in markets right now, particularly if we see the tariff policy as aggressive as Trump had come out and said he would make it?
I would agree with that point. I think that is the most underpriced risk right now. You're seeing things like small cap rally. Yes, you know, we probably will get some deregulation. We'll get a more domestically focused economy. And those are all great for small cap. But if you look back to, you know, the 2016 playbook, the 2018-2019 trade war, small caps actually underperform. And so you might think that small cap is not impacted by tariffs. But remember, small cap is sensitive to economic growth, sensitive to the CapEx cycle, and those things can be a headwind if we see these higher tariffs.
Yeah, it's true. Stocks did really well under Trump. in his pre-COVID presidency, right? After 2020, things went a little bit haywire, I think it's fair to say. But big tech did the best, at least as far as the major indexes. The NASDAQ 100 was up, I think, 70-some%. The S&P was up about 50%, and small caps were up like 25%. Do you expect big tech to continue to outperform? Because we've run so far so fast. I think Torsten Slok put out a note a couple days ago that showed that the top 10 stocks in the S&P 500 have an average PE of 50. That's pretty heavy.
Yeah, we think that the tech run can continue. Can we have some periods of pullback? We did see that over the last few weeks, absolutely. But we actually came out of the earnings season even incrementally more positive on tech. Why? Because the numbers put up, particularly within the AI space. The CapEx boom is happening. We actually lifted our expectations to the four hyperscalers. We think that you're going to see another 20% growth on CapEx for next year on top of the 50% that we got this year.
That's like, what, $500 billion of spending from those companies alone?
From those companies, $270 billion of spending from those companies alone. Yes, there's still questions about monetization, but if you look at throughout the earnings season, you did hear from some of these companies talking about improvement in terms of advertising and penetration there. You also heard from Microsoft, without offering a single stock view, that reality is they weren't able to deliver the cloud growth that people expected because they're bottlenecks. They're not able to get these data centers online as quickly as the demand is needed.
So it's interesting on that point on big tech also, you had data track out this morning saying that the U.S. large caps, they didn't just beat, they beat the broader U.S. equity market by a wide margin in Trump's first term. But the difference now is the bottlenecks that you've described, but also valuations. So do we think here at this juncture, if you bet on tech today, before Trump is inaugurated, then do you see that outperformance over the next 4 years like you did last time?
Well, you know, the magnitude is always up for debate, but we still expect outperformance. You know, our valuations elevated, absolutely, but a lot of these companies can grow into that valuation. We're continuing to see upward revision to some of the EPS. And once that monetization of AI starts to really ramp, we expect to see some upside to tech. But yes, valuation is something that we continue to watch, but we think that secular story behind AI is very much intact.
Plus maybe some M&A coming back.
Yeah, well, no, for sure. That's something that we're going to focus on this program in the next few weeks, for sure. Nadia, in terms of the House race, it still hasn't been decided. I note that a lot of votes are due to come in from California, which is, you know, historically left-leaning. What happens if there isn't a red sweep? What happens if the Democrats take the House? Are then all bets off on deregulation and lower taxes?
Well, you don't need a unifying Congress to do some of the things that Trump wants to do in terms of deregulation. A lot of this will be up to the heads of the different departments, right, in terms of he will put in place for the different agencies. Yes, the corporate tax part of it becomes more complicated and unlikely that we will get that. And then we have to offset that with the potential for higher tariffs. But we think that ultimately it's still a net positive for the market. We know that President-elect Trump cares very much about the levels of the S&P 500. And so we do think that the administration is better prepared now to be able to manage to do some of those risks. But yes, the ability to get all of that agenda through, we know, has to be in a unified government.
Well, to that point on taxes, say we do not get a full red sweep. How in play are taxes, particularly because the deficit we're looking at this time is so much wider than you saw in the last term he had?
Absolutely. I mean, it's 2 times, you know, as a percentage of GDP than it was in the first term. So yes, even in a red sweep, you're not sure if you're going to get everything through. There's going to be gives and takes. And so I think even in the red sweep, you're looking at some potential, you know, rollback of some of the IRAs, and that's why you're seeing some of those green energy names under pressure. But, you know, even with a red sweep, there's going to have to be some negotiation. Like, are you going to get the 15% cut to corporate taxes? Unlikely. Maybe it comes down to 20%. I mean, we've heard of President Trump, elect President Trump, talk about that 15% is really for those domestic manufacturers. That's complicated. We don't even know how that's going to be implemented. I mean, who determines whether something is, made in the U.S. or not, if you're importing parts into the U.S.? So we'll see. I think that taxes is something to watch. And, of course, the higher tariffs, which could come faster than the tax cuts.
Nadia. Thank you so much for your time here. Of course, a lot to digest in the market here. That is Nadia Lovell of UBS Global Wealth Management. Now let's get a look at some stocks moving ahead of the opening bell. We're going to bring in Abby Doolittle.
Let's start off with the shares of Datadog. They're down just a bit here, down 2%. This after the cybersecurity company essentially put up a good, decent third quarter, but the guide looking ahead a little bit less than what investors had wanted. That's true, too, for some of the dating app companies. A bit of a mixed bag here for connection platforms. We have the shares of Bumble right now down about 6%. They put up a massive loss. That view disappointing, but Match down even more, down 13.6%. They missed the sales number for the third quarter, and the fourth quarter view is seen as very disappointing. On the other hand, AppLovin, the connection platform among customers, well, that stock is absolutely soaring into today, up more than 300% on the year. There is a 10% short interest there, so that could be a piece of it. But they just beat adjusted earnings by 34% sales, so clearly the stock being rewarded. And then finally, let's take a look at the shares of Moderna. There's also a decent short interest on this stock. Into today, down almost 50% on the year, but they put up a big sales beat, 48% based on that COVID vaccine. Sales coming in for the third quarter at $1.8 billion versus the estimate of $1.2 billion. Investors liking it, sending those shares up 6.3%.
All right, Abigail, thanks very much. Abigail Doolittle looking at some of the stocks moving ahead of the open. Still got about 16, 17 minutes to go until the opening bell. Coming up, gold prices are stabilizing after an election day shock. We'll discuss the outlook for commodities with Barrick Gold CEO Mark Bristow next. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
In case you missed it, on Bloomberg Technology.
We are very focused on playing one game and one game only, and that is being free, frictionless entertainment for consumers. But what I will say is we are doubling down on the strategy. We believe it's working. We think the tailwind's in our favor, and it's on us to continue to deliver.
Whenever you're doing something innovative that hasn't been done before, there's a lot of trial and error and iteration. It just always has these zigs and zags along the way, and I think where we've been successful is really being reactive.
Hollywood is the history of technology. Like, we are here because of a technological breakthrough, right? And so we sometimes forget that art and technology kind of like come together always. And for us, it's like demystifying a little bit the technology. Again, if you understand AI as a tool for humans, then it changes the narrative. And it's less about fearing it and more about embracing it.
Don't miss Bloomberg Technology, live every weekday.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Something that was not caught up in yesterday's rally was gold. It's steadying now after plunging more than 3% yesterday as the dollar strengthened on Trump's presidential victory. Now investors shift their focus to this afternoon's Fed meeting, which could help gold. Joining us now is Mark Bristow, Barrick Gold president and CEO. Barrick is one of the world's largest gold producers. Talk about the cross currents here, because there's monetary policy, there's geopolitical risk, and now there is some certainty to the U.S. election, but still a lack of certainty around what the policies will be. What are the biggest inputs on what is driving the gold price higher to the extent that it will go higher from here?
So, Nelly, I think, first of all, we got to appreciate that gold is at a good place right now at 2,700. What we've seen is a reaction to an uncertainty in the United States. I think the big drivers of gold are still going to be de-dollarization by central banks. In the last 2 months, we've seen the Western investors come into the ETFs with ETF inflows, and we've still got that big overhang with the indebtedness of the developed economies in the West and the softening of the China economy. So still very bullish for gold as we sit today, and I think everyone's waiting to see what the new president of the United States says about, and what he, more importantly, what he does, given what he promised through the elections.
Yeah, I wonder, Mark, about gold's role as an inflation hedge. Certainly, yesterday's event, while maybe not surprising for markets, certainly was a surprise to, pollsters and I think many in the media. And you did see rates rise dramatically in the bond market on expectations of inflation due to tariffs. We don't know if that's going to happen. We don't know if they're going to actually cause inflation. Nonetheless, that's how the bond market interpreted it. Why doesn't the commodities market have the same interpretation? Why don't we see, a knee-jerk jump in the gold price when we have what most people expect to be an inflationary event?
So, Matt, I think that you saw confused indicators in the markets across, across the whole market, and I think what it was is, first of all, a message that people felt that maybe the Republican Party, and particularly Mr. Trump, was good for the economy broadly. But then, to your point, there are these uncertainties, in particular his statements around tariffs. I think there's a broader base that drive a broader set of indices that are driving the gold price, and that is that inherent global economic risk. And that's been the fundamental driver of gold now for well over a year.
I also want to switch gears and not just talk about gold, but also copper, a place that you have been diving even further into, and wondering what a Trump victory means for the copper market, particularly with the policies that he had said he would put in place, particularly when it comes to any setbacks to the energy transition and tariff strategy.
I think, Sonali, the copper is a fundamental metal. I always say copper is as strategic as gold is precious, and it's a fundamental metal in any construction-led economy, and definitely we're going to see that. And I think the world is going to be short of copper. So I don't believe that Mr. Trump and any policy introduced will impact the demand side of the copper equation in the medium to long term. In the short term, we're going to have lots of interference in copper, in that we have a brief period of projected oversupply before that demand equation kicks in, and I think that'll be compounded by everyone waiting to see what the policy of the new government in the United States will be. And we've still got China on the other side, producing lots of metal, putting it into the market, but on the back or on the basis of a softer economy overall.
I wonder what has been the driver in real terms, in direct terms, of the rise in gold prices. Is it government gold buying? Is it central banks around the world? I mean, you said something to the extent of, it's a hedge against economic uncertainty globally. Who are your biggest actual buyers?
So, Matt, the biggest are the central banks de-dollarizing their reserves, so shifting some of their reserves into gold, and we've seen that going on for a while. What's been interesting up until 2 months ago is the absence of investment into the ETFs, and that's really the way the Western investors invest in gold. And then you've got the big owners of treasuries, China and Japan to a lesser extent, and we've seen all those holders of treasury bonds lightening up on US dollars, and a lot of that goes back into gold. And then you've got all the other drivers as far as overall risk. And one of the biggest risks that people haven't really focused in is the budget deficits we see across the Western economies.
All right, so de-dollarization and big budget deficits, maybe things to focus on. Mark, great to get some intel from you. Thanks so much for joining us. Mark Bristow there of Barrick Gold. We are nearing the opening bell, and we continue to see equity futures gain in terms of a reaction, day 2 to the Trump victory. More market coverage ahead. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg.
Quick check here on futures. We continue to see futures gain. S&P futures up 0.3%. NASDAQ futures up 0.5%. Shanali, after yesterday's massive gain. In the Russell. I mean, 5.8% for the small caps, Russell 2000. That's big, right?
Huge. Most since 2022. Let's see where today brings us, Matt.
This is Bloomberg.
sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating. And then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to Bloomberg Open Interest. We have just 20 seconds to go until the opening bell on basically day 2 of Trump 2.0. In terms of futures, we do see gains again after the big gains in the cash trade we saw yesterday. S&P futures up 0.3%. NASDAQ futures doing a little bit better. We have the Russell 2000 futures down, but yesterday in the cash trade, the Russell 2000 was up 5.8%, which